New York City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures are higher this morning after the jobless claims rose to an 11-month high, boosting investor hopes for a September rates cut. Let's get right to it with the three things that you need to know to start your trading day. Yahoo Finance's Madison Mills, Josh Lipton, and Dan Howley have more.
Federal Reserve Chair Jay Powell signaling a rate cut to come in September while focusing on the labor market portion of the Fed's dual mandate. That signaled a shift in the central bank's focus on inflation, which has continued to cool. The Fed kept interest rates unchanged coming out of the central bank's two-day policy meeting. Here's what Powell said about the path forward.
A reduction in our policy rate could be on the table as soon as the next meeting in September.
Investors now pricing in over 85% chance that the Fed could potentially cut rates coming into that September meeting. This increased following those initial jobless claims coming in higher than expected as well.
And we're watching shares of Meta move higher this morning. The Facebook owner up about 2% in pre-market trading. The company beating Wall Street estimates and showing signs that solid digital ad revenue will give its AI investments time to pay off. Meta did warn the company plans to boost its capital expenditures growth in 2025. Shares of Meta up 34% so far this year.
And chip makers under pressure this morning. Qualcomm moving to the downside after originally jumping in the wake of its third quarter report. The company saw a 12% rise in its phone chip sales from a year ago, but CEO Cristiano Amon warned analysts on its earnings call that the company expects, quote, flattish to low single digits in growth in phone shipments this year. ARM shares are also in the red while the company beat Wall Street expectations and saw revenue grow 39% in the last year. ARM issued softer than expected guidance for the current quarter and the full fiscal year.
Our top story today, green on the screen, we're looking at all three of the major averages in positive territory. Let's go on back to those major averages here, just to give you a look at the futures activity that we're tracking here this morning, as we've got the S&P 500 futures right now pointing higher by about 0.5%. One of the huge things that we were focusing in on is just exactly where we moved during last month and some of the larger, more outsized points to really end and wrap up July. Ultimately, July was the worst month for the Nasdaq 100 and the Nasdaq Composite since April of 2024 this year. And here's a look at some of those big names that we were tracking. Let's give it a 1 month look here, just so people can see exactly where things moved and the red that really transpired for some of those big tech names, the mega cap tech stocks, and of course, one of the poster children of the rally over the past 18 months, really, NVIDIA, even though we're tracking that here this morning as well, over the course of the last 30 days was down by about 5.3% as well here.
Yeah, we saw a lot of the rotation that had played out in the month of July, a bit reverse on the final trading day here of the month. So let's scroll down here and take a look at what we have really seen in the past month of July to put that further in perspective. Now, tech stocks, it was the only one of the S&P 500 11 sectors to end July in the red. Mag 7 stocks lost $364 billion in market cap this past month. And as we have seen the start of a rotation out of the mega cap tech names into small cap names, the Russell 2000 seeing its best month that we have seen since December. So that rotation out of the mega cap names and names that have been leading the charge into the Russell 2000, that is a story that we've been telling you over the last 4 weeks. We saw a bit of a reversal of that yesterday. So the big question is, as we head into August here, the first trading day here of August, historically, seasonality wise, it is a weaker month, as is September. So lots of questions about what is going to come out of this earnings season. We have seen some hope about the AI trade, especially when you take a look at Meta and that move to the upside, on track to open up 9% here today. Let's talk a little bit more about Meta, because shares moving higher after its second quarter revenue rose 22% from a year ago. 98% of those sales coming from advertising. The tech giant also continuing to tout its AI investments, saying that it expects, quote, significant growth in CapEx in 2025. CEO Mark Zuckerberg commented on why tech stocks are focusing so much on AI on the earnings calls.
There are all the jokes about how all the the tech CEOs get on these earnings calls and just talk about AI the whole time, it's because it's actually super exciting and it's going to change all these different things over multiple time horizons.
Josh Beck, he joins us now. He's the managing director at Raymond James. Josh, it's great to see you here. So obviously the street very excited by what they heard from Zuckerberg last night, what they saw in this latest earnings print. What was your biggest takeaway from this and what this signals about Meta's placement here within the AI trade?
Yeah, well, thank you so much, for having me on. A big change from 90 days ago. Remember, Meta actually traded off. There were, I think, a lot of concerns on the amount of spend, particularly CapEx dollars, and their ability to monetize that CapEx. This quarter, much more positive narrative. I think they were very prescriptive, about this idea of fungibility. So not probably exactly something you expect to hear on every tech earnings, but it's basically the idea that they're buying a lot of GPUs from NVIDIA, which you mentioned earlier, but they have a lot of different use cases lined up. So I think more of this kind of disciplined investment philosophy was really a positive takeaway. And on top of it, the core ads business is just doing really well. It's growing in the low 20s%, and it shows you that already in their core business, they're benefiting from AI. So it was really quite a change from 90 days ago, and certainly viewed positively by investors.
Do you think consumers are fully grasping and users of these services are fully grasping the use cases for AI, and how much more do you think Meta can extract from those AI use cases that really contributes through to the average revenue that they're seeing per user?
Yeah, I think there's a lot of consumer interest. There's a couple of different layers there. I think at the moment what you're seeing is product like Reels, and the recommendation engine behind that is driving users to spend more time on the platform, which obviously creates a bigger advertising surface. So that's definitely in play. The newer element is certainly Meta AI. So this is a chat bot. They're using Instagram and Facebook to distribute it. They also have a standalone product, but there's starting to be kind of a new conversation on Meta that you would have never really considered before. So, hey, Meta, can you help me plan this trip with my friends? Not something you really would have ever considered on your time on Instagram or Facebook, but it's completely net new. So it's driving more time. It's helping their users kind of find a new use case on Meta. And, they're ambitious. They want to be one of the leaders there. And, certainly they're tracking really well. So I think the early consumer feedback is very good. And I would also just make this other point. It's not just consumer. So one of the areas we're really constructive on is enterprise. This has been a market that's not really been a focus for Meta really at all. But now with their new set of language models, Llama, they're opening a new door into enterprise budgets. And we're really constructive there. I think investors probably don't quite give them credit for it at the moment, but that's another kind of multi-year driver that's a little bit underappreciated about the story.
Josh, when we talk about the balancing act here between investment and then the want and need, at least from the street's perspective, from analysts' perspective, for that immediate impact to their bottom line, to their financials, are they doing a good job balancing that? Because it is something that has proven to be challenging to Meta in the past, and it's also proving to be an issue and challenging here for some of its larger cap tech peers as well.
Yeah, look, you're spot on. This is probably the biggest challenge facing the tech industry, and particularly the large platforms, is they see a multi-year opportunity that's completely changing the tech stack from the way the consumer behaves to the way the enterprise apps are built. So it's a massive change, and these companies have to walk a pretty tight rope. And I think what investors are holding them to is, okay, you can take your CapEx up, you can invest, but you need to be pretty prescriptive about where you see the monetization in your business. You don't necessarily have to give investors a number in terms of Gen AI revenue every quarter, but you have to give them a pretty strong sense of where you see the returns and how you're managing that capital. So, for example, if something doesn't pan out, that you can shift those resources elsewhere and still get a good return. And that was one of the real messages from Meta last night that I think was most positive. I think, some of the other tech companies have a little work to do to spell out their monetization story and how they're thinking about investment. But yeah, for Meta, I think today and kind of into the next year, they're in a really good spot.
Just lastly, Josh, while we have you, for investors this morning trying to kind of wade through the digital advertising thesis or theme within their own portfolio, is Meta the best game in town when it comes to digital advertising?
Certainly, it's a strong buy for us. The digital ad market, I think, is quite healthy right now. That was certainly an investor concern coming in. There were certainly some signs of weakness in certain verticals like food and beverage, but overall retail ended up very strong. That's probably the most important vertical. So yes, I think Meta's a really good investment because not only are they gaining share in the digital ad market, but they have these other emerging opportunities in enterprise. We also like Amazon. We think they're doing really well in the advertising space and also benefiting from Gen AI on the enterprise side with AWS. So those are some of our preferred plays. Reddit is another one that we like that we think is doing really well.
Interesting. Josh Beck, Raymond James Managing Director here. Josh, great to grab some time with you here this morning ahead of the opening bell and after these results and the call from Meta. Appreciate it.
Thanks so much.
Certainly. The Federal Reserve appears to be delivering on rate cut hopes, the Fed deciding to keep interest rates unchanged coming out of the central bank's two-day policy meeting in July. But Fed Chair Jay Powell's dovish comments signaling the central bank could cut rates at its next meeting, September. Investors now pricing in an 86.5% chance in totality that the Fed could potentially cut rates by 25 basis points at the September meeting, according to CME Group's Fed Watch tool. For more on this, we want to bring in Jim Bullard, who is the former St. Louis Fed president. Great to have you here with us, and thanks so much for taking the time here. I just want to get your read through on, some of the response that we had heard from Fed Chair Jay Powell in the press conference yesterday, what you make of his tone in comparison to the Jay Powell that you know.
Well, he's definitely set up September as a key point for the committee. I think the market pricing is about right, the 85% there. You do have two inflation reports. You have two jobs reports before that meeting. So it's possible that it would get derailed, but I think the committee's ready to go. I think it's appropriate. They're taking on board the considerable disinflation that their policy has brought about since they started in 2022. And so things are looking pretty good for the Fed and pretty good for a rate cut in September.
Jim, when you take a look at some of the softening that we have seen in the labor market, you have jobless claims rising to the highest level that we've seen in almost a year. We also saw some softening here in the ADP print earlier this week. Is the Fed, from your perspective, are they paying enough attention to, are they closely watching enough some of the deterioration that we are seeing in the labor market? And is there a real risk maybe that they are waiting a bit too late here if they don't move, or they're not going to move, obviously, until September?
Yeah, unemployment's been creeping up a little bit, but that was something that the committee predicted would happen. And the unemployment rate is still below most people's estimate of the natural rate of unemployment for the U.S., which would be somewhere in the mid 4% range. So you could see a little bit more uptick. I think what was unusual about unemployment was that it was below 4% for such a long time. You really had this extraordinary labor market in the last couple of years. So it's all about normalizing on the labor market side. Now, of course, the committee doesn't want to let that run away from them. And so they're certainly, paying more attention to it. They changed the statement a little bit to emphasize that a little bit more. But I don't think right now that they're in bad shape at all. The unemployment rate is still low by historical standards in the U.S., and other metrics on the labor market have come into line with where they were before the pandemic, and the pre-pandemic labor market was considered a very good one. So So it's more about normalization of the labor market than about deterioration of the labor market.
Jim, given your extensive time at the Fed, there's even during your time there been criticism that the data that the Fed is looking at is too far backwards looking in some cases where there is perhaps better data. And if you ask Kathy Wood, she would give you a whole list, as we had heard last year. Is there other data, though, that the Fed could be considering, especially if the data that we're seeing come in is actually going to show that we may be in a recession or may see, to Shauna's point, deterioration at a more larger or outsized level than is actually taking place in the near term or real time?
Criticism of the Fed? I never heard of it. No, let me just reassure your viewers and listeners here that the Fed looks at everything. So if there's any scrap of data that would help predict the future evolution of the economy, they've certainly got a team on it and have probably written a couple of papers about it. So the truth is that recessions are caused by big shocks. The pandemic is a poster child for that. You can't predict these big shocks, so you don't really know when they're going to happen. And that's why the future evolution is unpredictable. But you can track the economy pretty closely. And the Fed has a very large team that does that as best we can. Now, I would say that the use of real-time data has increased certainly through the pandemic. High frequency data, which is always available from financial markets, but from other places. So there's a whole ream of new information that wouldn't have been around, 10 or 15 or 25 years ago. So it has evolved over time.
Jim, what would you say is the biggest challenge or risk here to the Fed right now? Is it a much weaker than expected print tomorrow on jobs?
I think that would just send any of these particular reports are just one particular data point. So the chair did emphasize that it's the totality of the data and the total narrative. We'll see what we get tomorrow. I think probably the biggest issue here is now the debate will shift, because it'll be that September's got high probability, and how fast does the committee want to go? I think the baseline might be that they'll go at every meeting starting in September. And also, what's the ultimate destination? So I think that will, and most people would say 5 3/8 is too high for the policy rate right now. But where do you want to go to? Do you want to be in the mid-4s? Do you want to be lower than that, in the mid-3s? I think that's going to be a debate that heats up as we start this process. But overall, I think it's basically very good news for the Fed. They've got the economy growing near potential. They've got unemployment coming up to the natural rate. They've got inflation coming down to target. The only piece that they need to nail the soft landing is to get the policy rate down somewhat from where it is today.
And Jim, we heard Fed Chair Jay Powell yesterday just strongly denying that politics is going to make this impossible for the Fed to cut around the election. I'm curious, just from your time in the Fed, how is Powell and his colleagues thinking about this, the risk of cutting too close to the November election? Is that really an issue that they are debating?
Yeah, the thing about inside the Beltway is you can't make anybody, somebody's going to be mad at you all the time. So I think previous committees have looked at this and have said, well, we might as well just play it straight up based on the data and rationalize our decision based on the data and go that way and not worry too much about the election. I also would dispute the idea that anybody ever won an election based on 25 basis points at the September meeting. I don't think that's ever happened. So the notion that this has some kind of big impact or something on the election is kind of hyperbole, I think.
All right, Jim Bullard, great to have you. Thank you so much for taking the time to join us here this morning. A former St. Louis Fed president and dean of Purdue University's Junior School of Business. Thanks so much, Jim. Well, Qualcomm shares pulling back this morning after originally jumping in the wake of its third quarter earnings report. The chipmaker reporting a 12% rise in its phone chip sales from a year ago, but its CEO warning analysts on its earnings call that the company expects, quote, flattish to low single digits in growth in phone shipments here this year. So you take into account that's attributing to a bit of a reversal that we are seeing in shares, with shares off just about 3% here in early market trading. Now, Brad, when you take a look at Qualcomm and how it has been trading most recently here, obviously it has been caught up in a lot of the AI excitement, the role here. There's been a lot of influx in terms of what exactly that could do to their business, the upside potential of AI investments in the longer term. When you take a look at that 3-month chart, you are seeing that stock up. It is still in the green, although up just around 9%, so underperforming some of its peers on the street. But again, that upbeat revenue here warns of the trade curb impact. That is really what's maybe muting some of that upside momentum or optimism here in early market trading.
Yeah, I think one of the critical points could come later on this year, particularly in September, to see what the pickup looks like for smartphones or handsets as a result of a lot of the new artificial intelligence features that have been either talked about or put into market or teased by the major behemoths that are set to unveil their new lineup of phones. And they talked about this on the call a little bit last night. They're pleased with the growth and trajectory of AI use cases on smartphones. The expansion of those AI features, a precursor to next generation smartphones, which they believe will become AI-centric with this on-device AI working across applications on the cloud. What's that mean for Qualcomm? They essentially think that they are well positioned to drive some of that transformation. It's just a larger question of what the actual orders and shipments look like for many of the companies, and that is going to be where Qualcomm sees their own revenue uptick as well. As a result, we'll see. Also, let's turn to another major chip stock that we're tracking here today. Shares of ARM plunging as the company reiterates its annual forecast and gives light guidance for the current quarter, disappointing investors and overshadowing an earnings beat. Now, here with more, we've got Yahoo Finance's tech editor, Dan Halley. Hey, Dan, what did you take away from ARM here?
Yeah, Brad, the big thing here is clearly that guidance. Investors, analysts, they wanted to see ARM raise full year guidance, but they obviously ended up not, and that's why we're starting to see the move to the downside. ARM says expects full year revenue between $3.8 and $4.1 billion. That would be an 18 to 20% annual increase, and full year earnings per share of between $1.45 and $1.65. The Q2 guide disappointed investors as well. For revenue, the midpoint of the range came in below what analysts had expected. For adjusted earnings per share, the top end of the guide just met estimates. And ARM CEO Jason Child was pointing to some weakness in certain areas of the market. For the full year, expectations for royalty revenue growth in the low 20% range, below the company's prior expectations of the mid 20% range. And royalty revenue came in below estimates for the quarter. Specifically, Child says customer feedback revealed inventory issues in industrial IoT and networking. They seem to be more persistent than originally suggested. On the positive side, we did see the company beat on first quarter results. A number of analysts are seeing upside to the stock, naming a few. We have Deutsche Bank, JP Morgan, KeyBank, and Citi.
All right, Hallie, thanks so much for breaking that down for us. Coming up next here on Morning Brief, Carvana shares surging on a surprise profit in the second quarter. You're looking at shares skyrocketing up just about 10% here in pre-market trading. We'll tell you more on why next.
Carvana shares are surging after reporting a surprise profit in the second quarter. The company also projected 2024 to be a record year, with the CEO touting, quote, a lot of untapped potential for the used car retailer. Shares jumping, as Destiny's Child would say. They're up by about 10% right now. We're taking a look at the actuals versus the estimates on your screen. Better than expected on both of those fronts here. And ultimately, they did mention that the second quarter results, they say, clearly demonstrate the differentiation and the strength of their consumer offering and business model. They had said in very big font at the beginning of their press release, industry-leading second quarter 2024 results. And we'll see what the results hold for some of their other competitors. We may not hear from CarMax for a few weeks now. They just reported their first quarter fiscal year 2025 results in late June. So it'll be a little bit, and we'll be sitting on the edge of our ergonomic chairs for that one. But at the end of the day, some good stats here from Carvana at the end of the day.
Exactly. And I really think that this shows, one, the strong demand that they are seeing for their vehicles, but two, the improvement in inventory management, because I think that the inventory side of things has really been the issue for Carvana over the last couple of quarters. Now, they were buying, they bought a lot of vehicles throughout the pandemic at higher prices because of the current dynamics that were at play in the autos market. Then we're selling them at lower costs there. So obviously that put pressure on their margins. They have been able to right that ship just a bit here. So that, of course, has helped their margins in their most recent quarter. And then when you look ahead, their first ever annual profit, and they have also since been reducing inventory and cutting advertising and other expenses in order to strengthen their balance sheet. So that very much has been helping the company as of late. And you can see it also registering here with the street as you're looking at gains of just over 10%. Total retail units sold in the quarter, that was up about a third, up 33% to just over 101,000, with the company also expecting this number to rise sequentially there in the third quarter. So again, stronger than expected guidance there on sales. What they are expecting to see, or an improvement, I should say, in sales for the third quarter is also something that's encouraging to the street at this point. So again, you're looking at the stock with shares rising up just about 10% here, Brad.
Yeah, absolutely. The net income really, I think, something that investors are paying close attention to here. $48 million, net income margin of about 1.4%, as we were discussing here. As we're just seconds away from the opening bell, let's really set up today's trading activity. I mean, we've had a range of economic data. We had the Fed Chair Powell out with some spoken word yesterday, plus the decision coming from the committee to leave rate unchanged right now, but really setting up for the September meeting. So we'll see if we get that cut then. But of course, for a lot of the driving of this market momentum that we've seen driven by AI, that's going to be in focus by investors going into the opening bell here. A lot of AI chatter on the Meta call last night. Meta looking good here, at least pre-market, still holding on to gains of about 9%. We'll see where things open at the opening cross. Speaking of that opening cross, hey, you got a little magic at the NYSE, and at the Nasdaq, you got the first tee. Great organization, allowing a lot of young folks to get more access to the game of golf, a sport that you and I know very well, Shauna.
We do, and it's always great to get more players into the game of golf. Of course, First Tee has been doing great stuff now for several years. Let's take a look at where the major averages are opening here today. Again, like Brad just mentioned, coming off the back of some dovish commentary from Jay Powell, at least the market hearing what it wants to hear in terms of the likelihood of a September rate cut. You've got the Dow adding to its recent gains, up just about 0.4%. The Nasdaq also trading higher again. Of course, the question is, now that we're seeing some momentum back within the AI trade, chip makers were really leading the charge yesterday. You also have Meta up pretty significantly here at the open. The focus, of course, is going to turn to Amazon and Apple. Both of those names are set to report after the bell here today and will be a crucial test for the Nasdaq 100. We've got all your markets action ahead. Stay tuned. You're watching The Morning Brief. We are watching shares of Crocs today after topping second quarter earnings estimates, also raising its full year outlook guidance, though, for its third quarter adjusted operating margin. That came in below estimates, sending shares lower here today. You can see, though, at least revenue coming in essentially in line with expectations. You do have a beat on adjusted EPS of $4.01. Of course, when you take a look at Crocs, exactly what this tells us about consumer demand, we are seeing demand remain relatively steady, resilience on there. We have seen, I think more broadly, you can say overall so far this earnings season, we are seeing some cracks though within the consumer, but obviously that outlook there on operating margin outlook coming in just below estimates. That's really what's driving the stock here lower, at least in early action. You're looking at losses at just around 8.5%.
Yeah, some water really getting in between the holes over those Crocs shares right now. I tried. Anyway, as we're taking a look at things right now, not necessarily in sport mode, but some good stuff that we're seeing across the second quarters that actually did exceed the guidance on the enterprise metrics. The company is saying, Andrew Reese, the chief executive officer, saying that the quarter was led by their Crocs brand, exceptional growth internationally. So a lot of international folks looking to get more into sport mode. Maybe it's the Hey Dude, but as it relates to Hey Dude, they are trying to make some improvements to support long-term brand health, focused on driving some what they call brand heat by accelerating marketing in the second half of the year. That's a new spend that investors perhaps didn't account for. That's also going to be factored into today's trading activity.
All right, let's take a look at Moderna because shares are sliding here this morning. The pharma giant slashing its full year guidance because of a lower expected sales in Europe. You're looking at losses of just about 20%. Our very own Anjali Kamlani spoke with Moderna's CEO just moments ago. What did he tell you, Anjali?
Yeah, I actually got a chance to catch up with Stefan before the earnings call, and that clearly what he said on the call did not sway or help investor sentiment, as you saw on your screen with the stock continuing to slide this morning. They did a pretty good job on revenue, coming in at $241 million compared to analyst estimates of $130. Meanwhile, they missed on adjusted EPS, and as you just mentioned, they slashed their outlook for the year, looking at a net loss in the quarter year over year. So what I did talk to him about was those EU sales and what really happened, because we know that the COVID vaccine story is that you have to continue to be in the market. And what Stefan told me was that they actually had a problem because of the competition. Pfizer has locked up a lot of those contracts and there is no room in the market. So here's what he had to say about that.
So we've been working really hard for quite a long time to try to get some countries to order at least some Moderna. And that's what we had put in our budget and in our forecast. Unfortunately, over the last few weeks, we've spoke, and I've been to Europe myself. We spoke to several European governments in the largest countries of Europe that decided for budget constraint. As you know, the situation in Europe is not good. The growth is low. They still have quite a level of inflation. There's also a war in Ukraine, and every country is investing more in defense.
So as you can hear, a lot of macro pressure for them, especially with the situation in Europe. He is in France right now and wasn't able to, sway any governments there. But he also talked about why the U.S. market is different. In addition to the fact that Moderna is basically set up as now a seasonal business, aside from their cancer vaccine that they've been working on, everything else in their pipeline, the next 5 vaccines that are coming out or have come out, including RSV, are set up for a competitive market, a seasonal market. And so the company is looking at itself more that way. So the fact that we're getting this guidance early on is the reason why it's problematic for Moderna. Now, the U.S. market remains strong because the government is still looking at the use of doses as well as engaging with the company on contracts. But there's also another part of it, the pharmacies. Here's what he has to say about that.
The U.S. market is quite different. If you think about the U.S., because the retail pharmacy, if you want, unlike what's happening outside the US, that's all controlled by the government. The retail pharmacies are doing a lot of good work to promote to patients and consumers the different vaccines.
So even though they are able to do that, we still see the stock sliding. Clearly, the message to investors didn't get received. But I did ask him what he hopes investors want out of it or are looking for and what he can tell them to sort of assuage those fears. And he basically said, TBD, wait, but listen to what he had to say in his own words.
What I want investors to understand is that This is a speed bump. It's not a happy one. I'm not pleased about it, obviously. But if you think about the company, this company, most of the value is in the products that are going to be launching in the next couple of years, the pipeline.
So it looks like really the story from Moderna after the downswing of the COVID vaccines is just to wait a couple more years and see if the mRNA theory plays out, if the market actually sees the need for it and the boost. And that's where we'll wait for things to play out.
Anj, while we've got you here in studio with us, we're also tracking Teladoc shares here this morning. They're slipping, falling, can't get up. Can you tell us more on this? I mean, it seems like there's a little bit of a hit due to the revenue side of the business as well.
Yeah, so Teladoc has actually segmented its business into two very separate things. The traditional telehealth that you're used to, and then also mental health. And the mental health side actually dragged down revenue for this quarter. They're looking at ways to sort of revamp that and take a look, as you see on your screen. They just barely missed on the revenue side, but very heavily missed on the EPS side. And that is coming from a lot of internal operations and things that had to be taken care of. Now they're looking to expand the mental health side to the global market. They said that they took on a lot of cost for advertising. Interesting note, the presidential elections have driven up cost of advertising for them. And so while it is a hot market, generally the virtual mental health part of it, they haven't been able to break through. They haven't been able to do much with it. And so they're looking at a way to really grow the business there.
All right, Anj, thanks so much. Tracking everything across the healthcare industry and bringing it our direction. Great interview this morning as well with Stefan. All right, stocks moving higher to kick off the trading day, everyone, after the number of Americans filing for new unemployment claims hit an 11-month high last week, fueling optimism for a September rate cut. To discuss what this means for markets, we've got Jeffrey Kleintop, who is the Charles Schwab Chief Global Investment Strategist. Great to have you here with us this morning just after the opening bell. So, first and foremost, you get a reading like this on the jobless claims front, and of course we pair that with what we heard from Fed Chair Jay Powell yesterday. It seems like all systems are a go for a September cut.
Well, yeah, I mean, the market is pricing in 100% odds of a first cut in September. The problem, though, with that is that any disappointing economic data may no longer be welcomed by the market. There's no upside to the policy outlook and only downside from a weaker economy and labor market. In fact, the economic surprise index is now negative in the U.S., meaning data is coming in below expectations. And there's lots of data between now, of course, and the next Fed meeting on September 18th. Now, we've got the Jackson Hole Symposium on the 22nd through the 24th of August. That's probably the next take on how the Fed is seeing this data.
Jeffrey, that's a really interesting point because we have seen the market react, I guess, optimistically, maybe is the better way to put it, to some weak economic data. So now are we reaching that point where the markets are going to start viewing weak economic data as bad news then for the market? And what would be the cause, do you think, of that sentiment shift?
That's where I think we're at now. We've got a number of rate cuts priced in over the next 2 years, anywhere from 4, 5, 6, depending on whether you're looking at the futures or the options. It's a lot, and there's still a lot of services inflation. There's still a lot of issues around inflation. It's not perfectly clear that that's going to happen. And so I think what the more likely outcome is that the weakening economic data, particularly on the labor front, now we've seen job openings begin to level off. Now maybe we start to see it tomorrow begin to show up in actual job counts. That could begin to sour the market on the outlook for consumer spending, so important to sustaining the earnings growth we've seen this quarter.
And so, Jeffrey, as we're continuing to kind of look throughout the second half of this year and try to figure out, okay, if bad news starts becoming bad news, then what does that mean for some of the rotation that investors should be considering within their own portfolio positioning right now?
So I think I know tech is super hot right now. We're going through a week where we're getting a lot of good tech numbers, but I think we want to take a look at sectors like financials. The Bank of England's rate cut decision today was a close call. UK inflation's at 2% in May and June. Financials in the UK are outperforming the S&P 500, and that's because the yield curve there is now uninverting. It inverted. It's now re-steepening again. There's probably more steepening to go. The UK financial sector is up 18% in total return terms this year. That's ahead of the S&P 500. I think investors may be missing that with their just sole focus on U.S. equities.
Jeffrey, when you talk about some of that risk on rotation that we have seen, at least in the last 24 hours, 48 hours, we have seen a bit of a sentiment shift in terms of, it looks like that appetite appetite for some of these AI stocks is back, particularly when you take a look at chip makers. I'm curious, though, from your perspective, from a strategist perspective, how you're looking at the gap that we're starting to see form between the hyperscalers versus those that manufacture the chips, and whether or not you think that bifurcation maybe is something that's going to hold, at least in the immediate term.
I think it's interesting to watch. I think it's critical to take a look at what the policy environment is. It's not just the outlook for demand, but we've got this risk around the foreign direct product rule around the world. We've seen all the semi equipment and other related shares really rally powerfully. But if the U.S. does impose controls on foreign made products that even use the smallest amount of American products in their exports to China, that could be a major problem. ASML, the Netherlands company that is the biggest semiconductor capital equipment company in the world, gets 50% of their revenue from China. And yesterday we had a story from Reuters citing that those aggressive sanctions may not be implemented for Japanese companies and Netherlands companies. The market rallied on that. I think the market might be overlooking the reason those companies may be being excluded, and that's because they're probably going to agree to even stricter export policies on China. That could weigh on sales growth. That's something the market's not considering right now.
All right, Jeffrey Kleintop, great to get your insight. Thanks so much for hopping on with us this morning. Charles Schwab's Chief Global Investment Strategist. Thanks. NVIDIA's rally yesterday proving the AI trade isn't going anywhere anytime soon, at least for some, but the stock is still sitting well below its all-time high. We're going to dive into that trade on the other side of the break. NVIDIA shares climbing higher once again today. The stock soared yesterday, adding $327 billion to its market cap. It was driven higher by strong results from competitor AMD. Now, despite the recent rally, though, NVIDIA shares are still sitting roughly 13% below their all-time high. Joining us now for where NVIDIA and some of its competitors are headed, we want to bring in Stacey Raskin. He's Bernstein's managing director and senior analyst. Stacey, it's great to talk to you again. So it looks like a lot of that excitement has now returned. I'm curious, do you think there's been just this shift in sentiment following the AMD's results that we got yesterday?
So I don't actually think it was about AMD's results. I think it's about the CapEx guides we're seeing from lots of the hyperscalers, Microsoft and Meta and Google. All of those CapEx outlooks look very supportive, like we're starting to see those numbers continue to go up. And I think that's what's been driving the AI trade. I actually don't think really it was AMD's results. AMD's results were not bad. necessarily. They took their own AI guidance up a little bit, but I don't think they took it up any more than people thought they were going to. I don't think it was above where people thought.
So Stacey, then given that CapEx guide that we are getting from some of these hyperscalers, what does that tell us just about the opportunity, the upside here that we are potentially seeing for these chip makers?
Well, I mean, look, for companies like these, I mean, some of the numbers are very large, right? As you're looking forward in terms of where expectations are. And the hyperscalers, they're big customers. They're doing a lot of that spending, and so you do want to see those numbers go up. This was a concern if you go back, I don't know, a quarter or two ago. There was a big mismatch at that point between like where the CapEx outlook was at the time and a lot of these AI names, and we've continued to see the CapEx guides actually go up materially. I think even Meta reported last night, and not only did they take their CapEx guide for the year, they said that they're going to have like probably substantial increases next year, and so I think that's really what's important. The big worry that people have is just, is there an air pocket like coming? There's so much spending going on. The numbers have gotten so big so quickly. People worry about sustainability. And what we've been hearing from some of the customers is it looks like that spend, at least for now, is sustaining. I think that's what's been driving things.
And so, Stacey, as we think about growing into some of these valuations, I mean, what are these companies going to have to show that they can do in order to grow into the lofty numbers as we've been discussing?
Well, I mean, so be careful. Like lofty numbers, lofty valuations are two different things. Not all of these companies are expensive, right? You can look at a company like NVIDIA. It's actually quite a bit cheaper today than it was before the run started, a year and a half ago. Because as much as the stock has gone up, the earnings estimates have gone up far more than that. And so that becomes the question: like, are the earnings actually achievable? They need to clearly the numbers need to go up. I mean, I would say that given where the sell side numbers are, the buy side numbers are going to be even higher than that. And so any kind of increases we can see to customer spending, any sort of clarity we can get on business models, what are they actually doing with this spend is helpful. And I would say at least in the near term, what we're hearing from that supply chain and from the customers is constructive.
And so on the customer side, or at least on the demand side, I should say, is what we're hearing strong enough to sustain this long term, the growth? At least it seems like all of these companies, as they're talking about the demand that they're seeing, when they're on these calls and saying, well, the demand is strong, so we're just going to keep building it out, keep investing in it.
Yeah.
And so
I mean, that is what we're seeing right now, right? And there's also a little bit of, they're kind of in a fight right now. I mean, I think Google had suggested, what did he say? He said that, the risks of underbuilding were a lot bigger than the risks of overbuilding right now, right? And so, because they can use the capacity for something else if they need to, and they've got tons of money, right? This is one difference versus say 2000. These companies are incredibly well funded, and very profitable. They can afford to spend right now. But I think you're getting the heart of it. This is the controversy on some of these names. It's like the worry that just these guys tend to build and digest, and is there a digestion cycle coming on? And at some point maybe, but it clearly is not now. Like, I'm not really worried about it this year. I'm not really worried about it next year, given some of the product cycles and everything we've got. 2026, I don't know. I also, though, am very bullish on the long-term opportunity. I still think in 5 years or in 10 years, we will be talking about numbers that are materially higher than what we're talking about today. These things are never straight lines. But I do think as we're going along, like over the next like several years, it's up. I think the opportunity, the numbers we were seeing will be up.
Interesting. 2026 potentially the big test.
I mean, I don't know, right? I mean, we'll see. At least for now, for this year, probably for next year, I think things are fine. I think the spending is going to continue.
Yeah, I mean, you've got the modeling, Stacey, so we enjoy these conversations with you and getting your insights and perspective. Stacey, thanks for joining us this morning.
You bet.
Certainly. Stacey Rasmussen, who is the Bernstein Managing Director and Senior Analyst. Hey, everyone, coming up on the other side of this short break, all your markets action and just a few of those tickers that we're tracking here as we round out the first 30 minutes of trading. Hey, welcome back, everyone. We're taking a look at three of Yahoo Finance's trending tickers. Of course, there's a whole treasure trove of them, but we're focusing in on Hershey's, Roblox, and Shake Shack. Let's start with the chocolate. Hershey's shares are on the move right now, melting lower by about 1.9% after the food and beverage company lowered its full-year outlook, saying consumers are pulling back on discretionary spending here. More notably, they are mentioning that today's operating environment remains dynamic. Consumers are pulling back on that discretionary spending, but they are pleased to see the continued growth in the confection category, momentum building in the salty snacks portfolio. That's interesting here. I mean, at what point are we going to have these companies perhaps just admitting that maybe these GLP-1s are actually impacting the amount of chocolate people are purchasing?
Maybe. I'm still caught up on your first line there. Shares are melting lower.
Hey, I got love for Hershey. A great Pennsylvania company here. I spent my my senior physics trip there. At Hershey Park.
At Hershey Park. I had a couple soccer tournaments there growing up. All right, let's take a look at Roblox. Shares are in the red. The video gaming company raising its annual bookings forecast after engagement increased over the summer and more mature content attracted older users to the platform. Despite all that, you're looking at shares moving lower. They're off just about 3%. Why? Well, that's all because of its CFO, Michael Guthrie. He is stepping down, the company announcing his exit. He has been in the role for nearly 7 years. He played a key central role in the public listing of Roblox back in 2021. Shares have been off more than 9% in earlier trading, so they did pare some of their initial losses there in the pre-market, but again, still trading to the downside, and that is a big reason for that is because of the CFO exit.
Yeah, big time. All right, well, let's talk about one more company that we promised you here, Shake Shack. That stock is surging here today after beating the street's revenue expectations, its second quarter, and reaffirming its full-year guidance. Take a look at shares. They're up by about 19%, as investors are certainly snacking on this one right now. The Shack has a new CEO at the helm, too, here. We are getting to hear from Rob Lynch, who we actually interviewed here on Yahoo Finance back when he was at his old gig, Papa John's, the former Papa of Papa John's. But ultimately, as of right now, it seems like the analyst reaction pretty positive here. We've got one from Sarah Senator. Our own Brian Sazi forwarded this one to me. Appreciate it, Sazi. And ultimately says that the restaurant level margin was in line with consensus, modestly ahead of healthcare adjustments as well. So all those things considered, pretty good. I didn't meet the 30-second marker on any of them today. I didn't even try, honestly. There's so much excitement about these names.
We need that clock. It'll keep us on track.
Yeah, until you give us a clock, I'm going to go over.
All right, keep it right here on Yahoo Finance. Coming up, manufacturing PMI data getting released here in just a few moments. We'll take a look at what essentially that is going to tell us about where we are in the economic cycle, whether or not that's going to point to some deterioration in the economy. We've got that for you next. Just after 10 a.m. here in New York City, I'm Shauna Smith alongside Madison Mills, and let's dive into the catalyst moving markets today.
Stocks are moving higher here, though, pairing some of their earlier gains following that Fed cut hint-driven rally that came yesterday after Fed Chair Jay Powell did suggest that the central bank could be ready to cut rates come that next September meeting. Former St. Louis Fed President Jim Bullard joined the morning brief this morning to discuss the Fed's path forward.
Overall, I think it's basically very good news for the Fed. They've got the economy growing near potential. They've got unemployment coming up to the natural rate. They've got inflation coming down to target. The only piece that they need to nail the soft landing is to get the policy rate down somewhat from where it is today.
Tech stocks rising this morning. Meta is leading the charge. The rally pushing the Nasdaq and the S&P here to the upside. Now the indices, they're starting the month of August on an upbeat note, but this of course comes after the Nasdaq saw its worst month since April for the month of July. Investors now turning to Apple and Amazon, both of those tech giants reporting after the bell today.
And reluctant bullishness appearing for the AI trade after NVIDIA's rally this week. The chipmaker adding over $320 billion to its market cap, but the stock still sitting well below its highs that it hit back in June. What will it take for NVIDIA to get back to its all-time highs? We're going to discuss that later on in our show.
All right, first we want to get to some breaking data that we have out here this morning. Manufacturing PMI for July just released, falling to 46.8. That was below estimates here. When you take a look at, it was actually the lowest headline reading that we have seen since November. So contraction there. New orders falling to 47.4. You also had a drop in inventories as well as production. Employment also declining as well. When you take a look at prices paid, of course, very important to watch out as we try to gauge where we are in the inflation, fight to tame inflation here. Prices paid actually rising for the month to 52.9. That's from 52.1. So again, maybe pointing to some more weakening here within this print, Maddie.
Yeah, it's interesting to see a little bit of that softness, particularly coming on the heels of those initial jobless claims from this morning, coming in about 30,000 above the street's expectations here. You're still looking at gains in the major averages here. The S&P up 0.5%, the Nasdaq up 0.8%, and the Dow just below the flat line here. But again, Shauna, I think it's interesting for what you pointed out in terms of production falling down to 45.9 versus that 48.5 number. Inventories falling. Supply deliveries really one of the only ones that we see rising here, and prices paid also coming in just a bit above expectations and above the prior month. So interesting to see that kind of across this print, you're seeing the numbers coming in below estimates here. All right, well, continuing the conversation here following that ISM data that we just got in and those initial jobless claims coming in hotter than expected. Both of those data points coming in after Fed Chair Powell focused on the labor market more than inflation in his opening remarks at the central bank's meeting. Could the labor market be a problem for the Fed moving forward? Joining us to discuss, we've got Sinead Colton-Grant, BNY Wealth Chief Investment Officer. Sinead, it's great to have you here on set with us. Thank you for being here. I want to start with this ISM manufacturing data that we just got in here, coming in softer than anticipated. What is your take on the degree to which the market is going to be concerned about that throughout the rest of the trading day?
Look, it's another softer data print, but we've typically tended to see manufacturing sectors struggling a little bit more than services. You think about all of the readings and the commentaries around earnings where consumers are becoming a little bit more discerning in where they spend, how they spend, and ultimately that will feed back to manufacturing too. So yes, it's a lower print, but I don't believe that it's really new news.
Sinead, I'm curious what your takeaway was from Fed Chair Jay Powell's press conference yesterday, because it seems like the market is hearing what it wants to hear. Still looking at, even when you take a look at today's news, that some of that weaker economics still being priced in as good news here, at least for markets. Are we at an inflection point or a point where we're going to see that shift? And I guess what does that then potentially tell us about maybe some of the pressure possibly that we could see for equities down the line?
I think that the Powell comments were actually very much in line with how we're thinking about markets. So for quite some time, we've been of the view that you'd see fewer rate cuts than the market had been anticipating. And when you look at the comments from the press conference yesterday, it was very much inflation is coming under control. We prefer those numbers, but we're starting to get concerned about the unemployment rate ticking a little bit higher. We ticked just above 4% in the last reading, rounded up to 4.1. The great thing about deferring a rate cut until September is that the Fed now gets 2 more data prints in inflation and 2 more labor market reports to consider. So look, they always have the ability to move sooner if they think they see a very concerning situation unfolding. But here's the thing. Real interest rates, because we've got inflation under control so relatively quickly, interest rates haven't budged. So that means real rates have moved higher. It's naturally going to be more of a constraint on the economy. But what we believe about the labor market is that the softening is good. We're actually seeing more balance. And look, the Fed seems to be of the view that a rate cut in September is more likely. We think they go in September with 25, and then we think they cut another 25 in December.
So it sounds like you think they're going to be cutting in September for the right reasons, not because they're seeing something scary. Is that a correct categorization?
Correct.
Okay.
Look, 4% unemployment. Yes, we were as low as 3.4, but a 4.1% rate is still incredibly low when you consider where we've been over history.
What if we get 4.2 tomorrow?
You would want to look at the what is actually driving now. Which sectors are we seeing anything that's more concerning? Because if we see the unemployment rate move up because the participation rate has increased, that's actually good. That means more people are coming into the labor market. They're seeing it as more likely that they will be able to find work. So the reasons and the data behind it really matter.
So Sinead, what does this all tell us about portfolio management and maybe what some of our viewers, some investors need to be keeping in mind at this point? We had seen a bit of a rotation out of the larger cap tech names into small caps during the month of July. That has unraveled just a bit here over the last couple of trading days. Where do you see that leadership coming from?
It's a great question. And look, I think July was actually very healthy for markets because we'd seen such leadership coming from the tech sector. A little bit of retracement. It's really healthy. We're seeing more broadening in the market. We like the tech sector. We continue to like it. We think the benefits from AI in terms of productivity, the required spend on the AI theme is going to continue. But we also like industrials. We like healthcare. So we think the rally should broaden. That's extremely healthy. The other thing that's been curious about the last month or so has actually been the move into small cap, right? Mm-hmm. That all started with the softer CPI print that we had, which you extrapolate that to meaning rate cuts are more certain, they're coming sooner. The thing we know about small cap is that their debt profile is very different to large cap. They have more of a maturity wall coming through in 2025, 2026. And look, it's not that 25 basis points lower in terms of their debt service costs really makes a huge difference, but it's the fact that we're moving closer to a rate cutting cycle. And small caps have been particularly unloved over the last 12 months.
Right, and now we're starting to really see that rotation. And I should note the Fed swaps market is now pricing in 3 cuts before year end, so only cementing the argument you're making about the case for 2. I do want to switch gears slightly and pull up a chart that we have about the upcoming election that we got from your notes that just takes a look at how the market performs under different executive branches and then, of course, based on the split in Congress. And I should note that we are currently existing in the bar that you can see on your screen to the far left there. And you can see that is coinciding with strong market performance. What do you think investors should know about positioning ahead of an election? And what is maybe the biggest mistake that you think they should avoid?
The biggest mistake, without a doubt, is investing with your politics. That is the one thing you absolutely should not do. And what the chart shows is that equity markets can do very well under all types of administrations. We think that as you dissect the policy platforms of each candidate, there may be differences in terms of sectors that you want to lean into, but that's not today's decision. That is a decision for after the election, because what we also know is that if we have a divided Congress, then the policy platform may not be implemented in the way that it's articulated by the candidates today. But the clear message is do not invest with your politics.
All right, Sinead Colton-Grant at BNY Wealth, the Chief Investment Officer. Thanks so much for joining us here today.
Thank you. My pleasure.
Thank you. We're 40 minutes into the trading day and tech outperforming once again. This on the back of stronger than expected earnings results from Meta. You've got that stock up nearly 10% so far today. Solid ad revenue growth quieting some fears about increased CapEx spending on AI. Here's what CEO Mark Zuckerberg had to say about the company's spending plans going forward.
At this point, I'd rather risk building capacity before it is needed rather than too late, given the long lead times for spinning up new infra projects.
For more on that, we want to bring in Dan Morgan. He's Synovus Vice President and Senior Portfolio Manager. And we also want to mention that Synovus owns shares of Meta. So Dan, you're the perfect person to talk to about this. Lots of questions that we have been getting here from strategists, from investors, and even just taking a look at the street's reaction to these earnings prints so far is whether or not some of these larger tech names are spending too much on AI at this point. What do you think?
Well, it's kind of interesting because, we know during the second quarter call, Facebook or Meta came out, did say they were going to inch up their CapEx spending, which would be dedicated towards AI as high as $40 billion for the year. Just about all of the big mega tech companies are spending a lot of money on AI. What's kind of interesting, Sean and Madison, is that it seems that Meta came out and their core business was doing very well, right? Their efforts that they've had in terms of AI ad targeting seem to really pay off. Ad revenues were up 22%. Compare that to Alphabet, where ad revenues were only up 13% on their YouTube franchise and 11% on their larger frame. So it seems like if companies are able to spend a lot of money on AI and their core businesses are doing very well, they're rewarded. But if they're spending a lot on AI like Alphabet and they come up a little bit short on their core ad business, then all of a sudden the stock sells off. So it's kind of interesting.
Well, it's interesting, particularly given the varied reactions that we've seen from big tech firms reporting an increase in CapEx on AI. I'm curious from your perspective, what it is about Meta that is allowing them to underspend versus consensus. Their free cash flow continues to outpace CapEx. What is it about the management of the balance sheet at that firm specifically that's allowing for that to continue?
I think it's their past history. They put a lot of money into the metaverse, right? We kept hearing about that from Mark Zuckerberg. That was the new thing, right? 2 years ago, everybody was really excited about it. This is before AI really took off. And then they kind of got away from that and dedicated those funds over towards AI. And I think that's really helped them compared to other companies that are just kind of, in the last year and a half, 2 years since Microsoft, got involved with ChatGPT. They've all dedicated their funds towards or CapEx towards AI. So I think it's a fact that we're seeing a better return on investment versus metaverse, which is what Facebook, Meta was spending on before via AI. And I think that's why they're getting rewarded.
Yeah, it was interesting to see them sort of point out the examples on the call for how that CapEx is helping them versus maybe some of the other big tech names so far. Having said that, I also want to ask you about what we're hearing from CEOs about opportunity in AI. We've heard this kind of hint that perhaps there's more opportunity in AI than there was in, the internet boom and then maybe even in the cloud space. Would you agree with that?
Well, Madison, Sean, I hate to pop the balloon, but I've been following technology stocks since like 1990. So I went through the huge waves that occurred in the 90s, which was the build out of the internet, right? Everyone getting a mobile phone off a landline, the movement from a mainframe Unix to a client server environment. Those were huge mega waves that just drove tremendous amount of spending, especially building out an internet presence for every company in the US. And that's what really drove. Then, of course, you had the year 2000 glitch where everybody was trying to correct in their code. So you had like 4 major trends during the 1990s that really propelled technology. And, this most recent one in regards to AI, Madison, Shauna, the jury is kind of still out, right? Because we're spending so much money on it. We're really not seeing a huge amount of return up to this point from these hyperscalers. So I don't know if AI is at the same level as, going from, let's say 10 million mobile phones to 500 million mobile phones over a 10-year period worldwide. So I think the jury's still out. I don't know if AI is quite as big as some of those mega trends that we saw in the 1990s.
Dan, I'm curious, and what do you think that then tells us about the likely performance we're going to see from some of these tech names? Even when you compare, and I know it's just a very small data print here, but even when you compare the outperformance of the chip makers yesterday versus what we have seen in reaction to some of these larger CapEx AI spending plans from the hyperscalers, do you think we're going to see a widening of that gap for names like NVIDIA and AMD versus names like Microsoft and Alphabet?
Well, it's interesting because you mentioned AMD and NVIDIA. Like, if you think about the gold rush, would you rather be the person who's digging gold, or would you rather be the person that's selling the equipment to dig for gold? And NVIDIA and AMD sell the chips that allow companies like Microsoft, and we're going to get AWS with Amazon later today, Meta, they all buy chips from NVIDIA and some buy from AMD. So, it's interesting, Madison, Shauna, because we've seen these huge multiple stretches, right? Not so much with Meta, but with Microsoft. Apple's trading, I think right now, like 42 times earnings, 39 times fiscal year 2024. So you've had huge multiple expansions on a lot of these huge tech names that everybody's been involved with for the last 10 years. And now we're seeing a little bit of correction back again. And yet we saw AMD report numbers a couple days ago. They blew out on their data center business, and all of a sudden AMD and NVIDIA are taking back off again, and the multiples are off the chart. So there's a lot of recalibrating going on right now based on these earnings reports as we continue to get evidence that AI is actually impacting numbers.
So Dan, then what do you think that tells us about what we're likely going to hear from Amazon tonight? Are they going to be, do you think, under a bit of pressure or similar maybe sort of reaction to what we saw from Alphabet, and some maybe questions surrounding Microsoft's CapEx spending too?
Yeah, so I think everyone's going to focus on AWS growth, right? Because we saw GCP for Alphabet, that came in, I think, around 28.5% growth. We had Azure come in a little bit below at 29% growth. Street was looking for 30 to 32. We have to bear in mind that AWS, which is their data center service business, was growing around 12, 13%. Now, it recently accelerated in the first quarter to kind of like a 17 to 18% growth rate. So anything north of that, Shauna and Madison, that we can see out of Amazon with AWS, where they're showing some sort of direct result related to AI, where we did see, let's say, with to a slight extent with Azure, that would be construed as a positive. Now, if they go back and show deaccelerating growth in AWS and go back to their baseline before, which was around 12, 13% growth, that's going to be a problem. So I think all eyes on Amazon and all eyes on AWS.
All right, Dan Morgan, always great to get your insights. Nova's Vice President and Senior Portfolio Manager. Thanks so much.
Thank you.
Coming up, we're going to break down some of today's biggest movers. Again, when you take a look at the broader market action, you're still looking at the S&P holding on to gains. You got the Nasdaq outperforming once again here in early trading, up just about 0.3%. We'll be right back.
Shares of Anheuser-Busch InBev moving to the upside after profit beat expectations. Yahoo Finance senior reporter Brooke DePalma is here with her takeaways. Brooke, I know we were talking about this stock earlier. It's interesting to see AB InBev doing well when maybe some competitors, from my understanding, not doing so well.
Yeah, well, think about this. Anheuser-Busch is overcoming what was a really challenging 2023. So when you take a look at those comps, the company now coming out, slowly recovering from that challenging year that they had. The CEO's telling investors on the call this morning that their global momentum has continued this quarter. Now, investors are really focusing in on that margin recovery that drove a 10% growth in EBITDA, more than the roughly 9% that the street expected. But overall results were mixed here. Revenue coming in at $15.33 billion, a little bit lower than what was expected, roughly $15.49 billion. Adjusted earnings per share coming in higher than expected at 90 cents versus 86 cents. Now, I do want to take a closer look at two regions, the U.S. and China. Both dragged sales overall lower. If you take a closer look here in the U.S., revenue declined by 0.6% year over year, but the CEO did emphasize on the call that the U.S. market remains very resilient. Overall, they said that their beer market share here in the U.S. is now roughly what they called flattish. But Bud Light did reach a point of stabilization, and they plan to amp up marketing ahead of the NFL. The company also did note that those ready-to-drink cocktails segment did see volume growth in the high teens in the U.S. We're seeing that ready-to-drink cocktail category, think like a Surfside, which is not owned by AB InBev, but another company doing well, tend to pick up volume here in the U.S. Overseas in China, a far different story there. Revenue dropped 15.2%. Volume growth dropped 10.4%. The company blaming weather and a soft industry overall as that macroeconomic environment prevails. Of course, we heard from McDonald's and Starbucks, a similar story there. But the company did reiterate its 2024 guidance of EBITDA growth between 4% and 8%, taking into account inflation and those macroeconomic conditions. Some of the street saying that that guidance is a bit too conservative here.
All right, Brooke, great stuff. Thanks so much for breaking that down for us. We want to stick with the theme of earnings and take a look at Volkswagen because shares are moving lower this morning on the back of its mixed quarterly report. Yahoo Finance's senior autos reporter, Pras Subramanian, has been digging into this and joins us now with the details. Hey, Pras.
Hey, Shauna. Yeah, mixed results in a downbeat forecast, sort of reflecting the deeper challenges affecting large multinational automakers right now. VW reporting rising revenue despite falling overall sales. The gains are seen with better product mix and VW Financial doing better, but a slight profit miss here, a nearly 3% drop from a year ago. Items like unplanned severance, higher fixed costs hitting margins there. VW execs saying they need to bring down costs was said over and over again. In terms of its forecast, the company brought down profit and margin goals for 2024 too, reflecting investments it needs to make. In particular, investment in Chinese automakers like XPeng to bring new vehicles to market and cheaply in China. And also Rivian here in the US, investing in that joint venture with Rivian to make new software-defined vehicles using Rivian technology.
Pras, I'm curious from your perspective if you have derived sort of a thesis about the auto space throughout this earnings cycle so far, given that this is just the latest print in the sector that seems to be relatively mixed. I know they talked about, defensive moves and cost cutting and whatnot, but does this feel like one of the worst quarters that we've seen in autos, at least in your career, in your coverage?
I would say it's not one of the worst, but it's kind of showing some trends here that the good times may be sort of ending or kind of becoming a bit tapered off here. Volkswagen's U.S. rivals like Ford and GM also saw their shares take a hit following Q2 results. Concerns being, have peak profits already been hit? Pressure on pricing, those high prices have been such a thing that the automakers enjoy for quite some time because inventories now are rising. Consumers are also kind of bearing the brunt of higher financing costs and things like that. So sales are kind of coming down. People want more incentives, and that's going to hurt margins. Toyota, we saw Toyota today. They were seen as one that powered through with high sales of its hybrids and a measured approach to EVs. But what's happening now is that you're seeing shares today take a hit on concerns of slowing growth in places like China, and then also weaker inventories in the U.S. They don't have enough cars to sell here. On the flip side, we'll look at Ferrari. EBITDA up 14% compared to a year ago, boosting their profit forecast. The higher end still strong here. We saw that with Lamborghini too. So in the auto space, there are some winners, but you kind of got to look, and they're not usually the usual suspects either.
Praz, that was awesome. Thank you so much for joining us. Really appreciate you giving us that broader context there. Thank you.
Thanks.
Well, we are also watching shares of oil and gas giant ConocoPhillips ticking lower by just about 1.5% this morning, erasing some earlier gains. Now, this comes as the company beat profit expectations, and they're seeing oil production rising to a record high as of the latest quarter here. I just want to pull up some additional context here. Again, they had been rising by about 0.7% earlier in the pre-market after they did report better than expected adjusted EPS for the second quarter. There was a bump in cost guidance for the year. Perhaps that is one of the reasons that we are seeing the stock reaction. CapEx guided to the high end of the range, and operating costs were also guided higher for the year. JP Morgan maintaining their neutral rating following that news, but definitely seeing a negative push on the stock reaction. I think it's interesting that several companies have had to adjust their forward guidance so far a little bit higher than the street wanted them to. And we're seeing this primarily in some of those tech AI plays, but of course this is something that can come across the sector given the inflationary picture that we are seeing right now. That doesn't just impact the consumer-facing names, it could also impact a name like ConocoPhillips, the oil producer. So interesting to see the street kind of dinging those results this morning.
Yeah, when you take a look at Conoco, like you were just saying, I mean, overall, a lot of these numbers within this print is actually pretty strong. When you take a look at the profit beat, when you take a look at production actually rising to a record here. Revenue, though, did miss, and we have seen a bit of a common thread that you were just mentioning there, Maddie. A lot of emphasis this quarter on revenue, and any sort of miss there, we are seeing those stocks hit particularly hard. And when you talk about the high bar just across the board for earnings, if you're not beating and raising, many times the street taking a bit of issue with those results. So again, you're looking at ConocoPhillips here with shares off just about 1.5%. Keep right here on Yahoo Finance. You got much more of your market action ahead. You're watching Catalysts. You've got the 10-year Treasury yield dipping below 4%. You can see that drop up there on your screen. It's the lowest level that we've seen since February. Now, this on the heels of ISM manufacturing data coming in softer than expected. Then when you take a look at what we could get here from the Fed in the coming months, the next big data point here for the market and for the Fed is Friday's jobs report. It's one of two jobs report prints that we are going to get prior to the Fed's next meeting, which is scheduled for September. Joining us now, we want to bring in Leslie Falconio, UBS head of taxable fixed income strategy. Leslie, it's great to see you. Let's start with the movement that we're looking at in yields here today. You've got the 10-year yield now below that 4% level. I think the question that some are asking on the street is whether or not this move that we've seen in yields, if it's overdone. What do you think?
You know, we've had a buy the dip mentality, and our view has been that you should be adding that duration around 4.5%, and we did believe and do believe that that yield should come down. However, when we look at what's happening this morning, particularly after the rise in claims, the market is once again getting well ahead of itself. I mean, it's pricing in almost 81 basis points of cuts in 2024, 110-ish in 2025, and now it's looking at a terminal rate of around 347. And we've been through this before, right? We've been continuously when the fixed income market, which is forward-looking, and the Fed, which is backward-looking, you have the fixed income market has numerous times reassessed and repriced. So what ends up happening is, if the data should come out stronger, yields go up. So we do think that we definitely wouldn't buy at this level. Overall, we think yields come down, but we do think it's gone down a little bit too fast, and the market is definitely a bit too dovishness versus what the Fed has guided.
So what does that mean for investors then, Leslie? For those who have maybe been thinking, they were behind the curve in terms of getting in the Treasury space, and they're thinking that they do still want to get in before the Fed cuts, where should they be looking along the curve?
We've had two things. Our duration has been that 5-year. We like that 5-year part of the curve. It's definitely the sweet spot. It leads the way when you have a shift in monetary policy. It leads the way down in yields when they turn dovish, up in yields when they're hawkish. And because we do believe the Fed is going to cut twice this year, right? So we do believe in the 50 basis points of cuts in 24. We've been centered around that 5-year. Right now, I don't think there's anything wrong with owning that short end, that 1 to 5, but you don't at this stage want to go further out the curve, particularly when, as you pointed out earlier, you're looking at a 10-year, the WI 10-year, getting to around that 398, 397 level.
Leslie, when you take into account kind of what the bond market has been pricing in really over the last several months, certainly have been a bit more aggressive in terms of plans here for the Fed. Is there a bit too much optimism, do you think, at all priced in, or is that more coming into a more realistic view on the heels of what we heard from Powell yesterday?
I think the market is getting a little bit of concern that they've waited too long, right? It's our view as well that the real yield, the real effective funds rate is high and they're restrictive, and that's our view as well. But we still believe in the soft landing. Now the market's kind of like taken a shift because they've held, they've been on hold for a year plus now. The market is thinking to itself, you might be a little bit behind the curve. So when you see some things like claims go up, and this is what the market is looking for, because there's a difference between the unemployment rate, say, ticking higher because of, supply getting into rebalancing versus there being an increase in layoffs. And we haven't seen that increase in layoffs yet. And that's why these claims numbers are so important. So I think the market with the claims number this morning, even though it's a little bit of a nuance because of the hurricane, the claims number this morning, the weaker ISM, people a little concerned about tomorrow's payroll number, and they're sort of pushing the Fed into saying, hey, you might be waiting a little bit too long before you move.
But what if we get evidence in that jobs number tomorrow, and then we've got one more before the September meeting? What if that does start to show a little bit of weakness? I know in your notes you talk about how you continue to anticipate 2 non-recessionary cuts. If we do trigger that SOM rule, does that non-recessionary wording from you change a little bit?
It doesn't right now. And we believe that, the data is going to be weaker, but not weak. We expect growth to be trend or maybe a little bit below trend, but we're not looking for a recession here. But I will say this, given how tight fixed income risk assets are, both high quality and particularly lower quality, bad news is bad news, right? You're not going to have the market rally because of a weak number and have spreads compress anymore. You're going to have a concern, that it's potential that we might have a recession, even just modest, and spreads will widen. Now, overall, it's not our view that we go into a hard landing. We still think in the soft landing. We still believe that, growth will be below where it's been, but not to a point where it's at a recessionary level. But the markets are just so compressed and spread with so much cash on the sidelines, so many people sort of capturing that yield in fixed income, which has been ample and what we haven't seen in several years, that if we do get that weak data, spreads are going to widen out.
All right, Leslie. Well, thank you so much for joining us. We really appreciate your insights as always. Thanks for making the time. That was Leslie Falconio, UBS Head of Taxable Fixed Income Strategy. Well, gold futures also moving higher this morning. That move to the upside coming after dovish comments from Fed Chair Jay Powell. Joining us now on the latest moves, we've got our very own Inez Ferre. Hey, Inez.
Yeah, Madison, that Fed decision spelling out the likelihood of a September rate cut, that really sent gold futures soaring yesterday. And we can see right now that gold is up 0.9%, just below the 2,500 level. But I'm going to pull up the commodities chart so we can take a closer look at gold futures and what we have seen. As far as the high for today, we have seen it go above 2,500. So that's a significant move. We have seen also over the last several sessions, we've seen significant moves higher. Part of this has to do with that expectation of a rate cut, because if you have lower interest rates, because gold doesn't pay a yield, it competes better against other assets. You also earlier this week had heightened tensions in the Middle East. That sent gold higher. You also had the Bank of Japan's decision to raise their interest rates, which indicates a move lower in the US dollar. A weaker dollar equals higher gold prices. Speaking of that dollar, though, we have seen this morning a little bit of a tick higher in the US dollar index. So even though we saw gold moving higher this morning, it's off that high, guys.
All right, Inez, really appreciate you joining us on that, and a great reminder of what's going on in the gold space, particularly as we head into that November election, gold getting a lot more attention here. Now, coming up, chip stocks pulling back today after rallying in the wake of AMD's results yesterday. You can see across your screen here some pressure in the semiconductor space, but again, after a big rally yesterday. We're going to break down that trade and the road ahead on the other side of this break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Chip stocks losing some steam today as the Nasdaq rolls over earlier gains, giving up some of those earlier gains on that softer than expected manufacturing data. Now, today's move to the downside, what you are seeing play out within the chip sector, follows yesterday's risk on rally. Actually, looking at yesterday's move, the chip sector recorded its largest single-day gain in 14 months. Who led the charge? Well, it's none other than NVIDIA. We want to bring in Paul Meeks. He joins us now. He's Harvest Portfolio Management's co-chief investment officer. Paul, it's great to talk to you again. So we're seeing a bit of a give back following yesterday's gains. Nothing necessarily to get too worried about, I don't think, up until this point. I'm curious, though, what you make about the sentiment, the narrative surrounding these chip makers, and whether or not some of the developments that we've seen this week makes it more likely that we are going to see another leg higher.
I actually think we will see another leg higher, but even in my own tech portfolio, I have a prohibition right now on new buying, at least till we get through this very weird and squirrely earnings season. Because as we've gone through this earnings season, some companies are posting pretty strong results. Whenever a company posts earnings, there's always going to be a couple flies in the ointment. I mean, that's to be expected. But companies that have had good things to say, sometimes their stocks go down the next day. So it's just too difficult of a market. I plan to add to my favorite AI infrastructure plays, which would be some of these semiconductor names, data networking companies, and data server companies, but only till we get through the end of this reporting season. Give me about 2 weeks.
Okay, well, a lot of follow-up questions potentially off of that, Paul, but I want to start on whether or not you think come NVIDIA earnings, when given the beats that we've seen from the likes of Meta, Microsoft, Alphabet, and Amazon, all of those make up 40% of NVIDIA's revenue. I know we're still waiting on that last name. Given that we've seen those positive earnings from some of those names so far, do you think you'll regret not buying NVIDIA when they're likely to have a good quarter based on that?
I think I may regret it, but I have such a large position and I've held it so long at such a lower cost basis, I'm pleased to wait. But you think about it, all of their customers, the hyperscalers, we're now through all of their quarterly reports. And the only thing that was not controversial at all was how much damn money they're going to spend on AI CapEx. And so unless they're lying about their capital expenditures are high and potentially even rising into 2025. So this bodes incredibly well for NVIDIA. And NVIDIA is trading at 31 times next year's earnings. It's not egregiously expensive. So I plan to, when the stock settles and or we get through their report on August 28th, you know what? I'll probably buy some more.
Well, I'm curious because you mentioned NVIDIA a lot. We all do, right? Just because it's so dominant within this space. We did see a lot to like in AMD's report. When we look at that roadmap ahead, is there an opportunity for AMD, for some of these other chip makers, to close that leadership gap that we have seen for so long from NVIDIA?
I think that they may close the leadership gap a bit, but not significantly. I mean, take a look at AMD. Yes, when they reported the other day, they moved their guidance from $4 billion in AI chips this year to $4.5 billion. And the prior quarter, they went from 3.5 to 4, but it's still going to be a sliver, an absolute sliver of what NVIDIA is going to do. So over time, the pie will get bigger. I still think that NVIDIA will have most of the slices. And AMD, hey, it's a strong, well-managed company under Dr. Lisa Su. They'll be a good second supplier. But NVIDIA will have a hold on this market for as far as the eye can see.
Paul, remind me, do you own Amazon?
I sure do.
Okay, so we've got Amazon earnings on deck here. We're looking at cloud growth above 17% for AWS. To what extent do you think that that could be a positive story for Amazon as we head into their earnings today? And is there anything else that you're looking at under the hood in terms of their cloud growth revenue specifically?
Yeah, you're absolutely right. I don't even look at that company as an e-commerce company. I hope that they will continue prior to last quarter, sequentially increasing that year-to-year revenue growth for AWS. You do not expect the 29% that we just saw for Microsoft Azure and for Google Cloud. But as long as they continue to accelerate, I'm pretty comfortable.
All right, Paul. Well, thank you so much for joining us. Really interesting points, particularly on NVIDIA earnings as a potential buying opportunity. We appreciate you making the time here. Again, that was Paul Meeks. He is Harvest Portfolio Management's Co-Chief Investment Officer. Now, coming up here, we're going to continue to have all of your markets action ahead. You're looking at a market that has flipped its head following that manufacturing data here, moving to the downside, particularly in the S&P and the Nasdaq. The S&P down 0.6%, the Nasdaq down 0.7%. We'll continue to cover the market moves after the break. next big data point investors will be keenly watching is tomorrow's jobs report. All eyes will be on not only that top-line job growth number, but also the unemployment rate and what a tick higher could signal about the overall state of the economy. For more on that, we've got our very own Josh Schaefer, who wrote about this for us. And Josh, talk to me specifically about, you talk about this rule that could be triggered by the jobs print. Explain to our audience what that is and the kind of stress around it.
Yes, Maddie. So we're talking about the SOM rule, and it feels like everyone is talking about the SOM rule right now heading into this jobs report, that July jobs report. So the key takeaway here would be if we get the unemployment rate at 4.2% in July, that would be above expectations. The SOM rule would trigger. So what you're looking at right now is the tracking of the SOM rule over a short-term period, and you can see how it's been ticking higher. So the SOM rule takes the three-month average of the national unemployment rate, and when that has risen by 0.5% from the previous 12-month low, so when it hits that blue line, that is a recession indicator that has been accurate dating back to at least 1970. The key takeaway, though, thus far has been Claudia Sahm herself, who invented the rule, is a little bit less concerned about this being an issue, largely because of the increase we've seen in the actual workforce, the increase in immigration. And Fed Chair Jay Powell actually talked about this yesterday, and I thought he had a pretty good description as to why people are a little bit less concerned about this right now. Let's take a listen to what he had to say.
The question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen.
Powell went on to discuss other recession indicators that haven't necessarily been right this time around, or at least not right yet. He talked about the inverted yield curve and said basically thus far this time has been different, so why are we to believe that this indicator also couldn't be wrong, which I think is a relatively fair point, Shauna, and perhaps better than the economic math that we could get into here. But it still seems like markets might take it as some level of a concern if it keeps going up.
Yeah, and that's a great point, because there have been a number, and even people on our air, that have pointed out that this time is different, especially when you take a look at the dynamics that are playing out inside the labor market, exactly the point that Claudia Sahm was making. But let's talk a little bit more about maybe what this could mean for the markets if we do see the SOM rule trigger. How bad could that be for the markets? Just judging, let's take today's market moves here as an example. We have seen this move lower now on worrisome econ data news. Is this the start maybe of something larger, of a larger trend?
Let's put it this way. It takes pretty interesting math to get to why the unemployment rate going up to 4.2% isn't a bad thing. Mm-hmm. And if it needs to be explained that much, then maybe markets won't react that positively, right? There's sort of a positive spin here you could get to, but it's not the headline read. So I think if you get that print right at 8:30, maybe that's not a good sign for markets. You've seen bad news kind of look like bad news for stocks, at least thus far this morning. Maybe that continues tomorrow. Again, if we get that increase in the unemployment rate, we don't know that that's going to happen yet. It's not necessarily a definite.
Yeah, that's true. Well, we will see. Only time will tell. Less than 24 hours.
We'll be back here again to break it all down.
We'll be back here discussing it. All right, Josh Schaefer, great stuff. Thanks. Let's take a check of the markets. Josh was just mentioning some of the outflows that we're seeing across the board. You've got the Dow now off right on the lows of the session, off about 0.8%. You've seen a reversal for the Nasdaq. The Nasdaq had been trading higher. Now it's off about 0.5%. You've also got the S&P 500 under pressure. Now the losses being added to where we saw more losses here following the manufacturing data that we got out at the top of the hour. Keep right here on Yahoo Finance. Coming up, Wealth. It's dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, a global strategist lays out some of their top sector picks that you might want to consider investing in. And the labor market in review will break down what the jobs market looks like for job seekers, stayers, and those who just want some tips. We've got those from a LinkedIn career expert. Plus, Jerome Powell, the Fed chair, indicating a September rate cut may be on the table if inflation continues to cool. We'll tell you how to get, and well, ultimately how a cut could affect your monthly auto loan payments. Everyone wants a little advice there. All right, let's get to it. Markets paring back some of the earlier gains after soft manufacturing data prompted concerns about the economy. Here to discuss the markets and what sectors make the best investments right now. We've got Veronica Willis, who is the Wells Fargo Investment Institute Global Investment Strategist. Veronica, great to see you as always here. First and foremost, let's just start with some of the economic data readings that we've had come in and what it's telling us about the state of the economy right now, especially going into September, where we're anticipating that the Fed may finally cut rates.
I think, what we're seeing with economic data right now, signs of a slowing economy, signs of a labor market that's normalizing. We've had a really robust labor market over the past couple of years, and these most recent readings are all showing that, that market is starting to get to more of those normal conditions that we were seeing pre-2020, but not something terribly concerning or a weak labor market by any means.
So with that in mind, what is the investment positioning that those out there who are trying to figure out how they should best be positioning their portfolio or what the playbook is for a potential rate cut?
Yeah, so, right now we've recently moved favorable on the financial sector. That's one sector that is really going to benefit once the Fed starts to cut rates. So getting in at this point now before the Fed starts to cut is a really good opportunity, a really good play. We think that, financials can do well over the next 6 to 12 months or so. We also really like, the energy, materials, industrials, and healthcare sectors. We think during an economic slowdown, those sectors are going to be positioned well. And they're at some attractive valuations now. So maybe rotating out of some of the sectors that have really done well, that maybe you're overexposed into some of these other sectors that we favor could be a great idea.
Even within this, and we're taking a look at some of those sectors that you mentioned here on the screen, and I'm zeroing in right now on XLK. Right now, that's down by about 1.7% on today's activity. Of course, technology has been one of the kind of core focal points over the course of the trade the last 18 months or so, especially with AI being a theme that's just been off into the races here. Would love to get your evaluation of that, considering the runway that we've seen already and what type of runway has left, perhaps.
Yeah, the tech sector has done really well. It's been really impressive, but valuations are getting high. They've been high for a while now, and so we're not recommending overweighting that sector at all. We are neutral on the tech sector, and I think what's key to remember there is how large tech of a sector is if you're thinking about something like the S&P 500. So even a neutral full exposure to that tech sector, you're going to participate when tech is doing really well, like it has been in recent years.
Veronica, it's always interesting every 4 years when we get into an election cycle or general election season and trying to best estimate how the market is going to react to the campaign talking points and the debates as we get closer to election day. And then, of course, the outcome. What have we seen in election years past that might repeat itself this year? And is this year perhaps its own bear? It's its own kind of differentiated event?
Yeah, each election is different, but I think what they have in common is the potential to contribute to some market volatility. And it's going to be just one potential catalyst for that market volatility the closer that we get to the election. What's important to think about is that the trajectory of the economy is what matters most for markets. And, either election outcome, the economy is already on a trajectory, and any particular election outcome is unlikely to change that trajectory of the economy, especially for the next kind of 6 to 18 months or so. And so focusing in on those expectations for the economy, it's better for that kind of longer term outlook for the markets.
Really solid perspective, insights, and analysis as always. Veronica Willis, who is the Wells Fargo Investment Institute Global Investment Strategist. Great to see you here. Thanks so much for taking the time,
Thank
Veronica.
you.
Certainly. Everyone, let's turn back to the jobs market here. New jobless claims, they were out this morning. 249,000 people filed for unemployment last week. That's about 14,000 more than forecast. Here to dig into the details, we've got Yahoo Finance's Catalyst's co-host, Madison Mills, here in studio. Hey, Maddie.
Hey, Brad. So we are starting to see some cracks in the labor market, and tough news, particularly for those who are currently out of a job and looking for one. Now, let's just run through a little bit of why this report was not the best news for job seekers. Jobless claims hitting an 11-month high here. We saw continuing claims also ticking up. It kind of looks like a hockey stick if you look at those continuing claims, and that's not really what you want to see, right? You kind of want to see an L or even a downward spiral, at least if you are a job seeker, not necessarily if you are a member of the Federal Reserve. But having said that, it does look like we are seeing an uptick in people who are seeking unemployment benefits in particular. Now, we are going to get more details on this as we head into the jobs report tomorrow. We are interested in seeing whether or not the unemployment rate ticks above the 4.1% level. That's what it's been at. That's what it was at in the last print. If it ticks above 4.1%, that could be a bad sign for the future of this labor market. Something that a lot of our guests have also told us, though, is that they're looking at the layoff percentage that has been holding just around 1%. If you start to see layoffs ticking up, that could be a sign that companies that have just held back on hiring or maybe kind of taken some other tactics to get people to leave on their own accord in this difficult economic environment, if they start to move into even more defensive action by actually having layoffs, and we see that come up in the data, that would be a final bad sign for consumers. And also, I should mention, it could be a final bad sign for the market. We saw the 10-year yield ticking below that 4% handle. That would also be bad news for those investors out there who have not gotten in on that 5 handle for treasuries. Now that has kind of shifted. We had a guest earlier saying that if you do still want to get in treasuries, you should be looking at the 5-year. You're taking a look at that across your screen right now with the 10-year hanging just below 4%, again, off of not only those jobless claims, but also manufacturing data from this morning coming in softer than expected. That doesn't necessarily impact the average worker listening in on this show, but it is a sign of some softness in that sector specifically, which could be indicative of more bad news to come.
Maddie, thanks so much for breaking this down for us, especially as we're going to be waiting for Friday's all-important monthly employment situation, which we're all going to be breaking down together.
8:30 a.m. tomorrow.
I can't wait.
We'll
Can't
be
wait.
here.
Got my coffee
on
ready
Friday.
already. Well, kind of. It's it's easy baked coffee. Anyway, let's keep with the labor market for a hot second. Jobless claims are rising to an 11-month high, and with the latest ADP data showing smaller than expected private job growth in July, it's more important than ever to be strategic when looking for your next gig. Here with some tips on how to stick out from the rest of the field. We've got Andrew McCaskill, who is the LinkedIn career expert. Andrew, great to see you, and thanks for joining us. I mean, you were just hearing us break down some of these labor market statistics and the readings that are coming in. And one of the huge things that I kind of point back to is what we got from ADP. And we heard from the chief economist, Naylor Richardson of ADP, saying that with wage growth abating, the labor market is playing along with the Federal Reserve's effort to slow inflation. If inflation goes back up, it won't be because of labor. I'm not going to ask you about inflation, but for those out there that are trying to make sure that if they do need to get a new job or a new gig, how they can best make sure to maximize the wage that they're able to get, knowing that they're probably trying to offset some lingering inflation.
Listen, I think that right now it is absolutely employers are in the pole position in a way that we haven't seen in the last 18 to 24 months. I think that, for folks out there right now, unemployment is still low, right? But job quits are down. You just talked about that. Job quits are down. We haven't seen companies talking about layoffs, and people are staying in place in their jobs. The great sort of resignation and the great reshuffle, which we called it, that is over. I think this is probably the beginning of the great stay. people are looking at, it's an election year. They're looking at a lot of the uncertainty in the market, and they're staying in place at jobs, even if they're sort of iffy about said job. And so folks are saying, well, look, if unemployment is down, if people aren't getting laid off, why the hell is it taking so long for me to find a job if I'm a person who's in the job market right now? It's that the market is highly competitive. Companies are still hiring. Hiring has stabilized, and companies are making really tough decisions about, I really want to make sure that I get the right person in place for this role because I'm not going to be hiring for a while. And I would say, and this is, I'm not an economist or a fortune teller, but I can tell you that we're going to be hearing this for at least the next 12 months, that the market is incredibly competitive for jobs.
With that in mind, and this is the first that I've heard the great stay, and perhaps some of our viewers as well. So how long do you anticipate people, employees, and those in the labor force are thinking out, or at least gaming out, staying in current roles in order to make sure that they can outlast some of the larger macro effects that perhaps concerning and keeping them in those positions?
Yeah, I think a lot of folks who are actively thinking about a career pivot, the folks who are in place in roles now, they're really looking across the board and trying to figure out, before I leave this job or before I jump into the market, what is it that I really need from work in general? What is the next move for my career? And can I get that at my current company? That's one of the big questions that they're asking themselves, and it's a smart question to ask. Folks are looking across the bow and saying, in the next year, listen to me, in the next year, what could I do now to be in a new position in the next year? That's really important. So people are putting those plans in place now to start to think about what industries are hiring. Am I ready for maybe making a geographic move, right? What am I willing to give up to get a new job? And how do I position myself with the right skills to make sure that when I get into the market full force, that I am matching up the skills that I have with the top skills that people need right now? People are putting those plans in place now and thinking about a year out.
I like to always give people some actionable tips when we have a conversation with you, Andrew. And some of the tips here, they're seeing them on screen for job seekers. We're going to layer on another part to this too, though. When you're negotiating that salary, if you are switching jobs, what are the things that you should be keeping in mind and taking to that negotiation table?
Yeah, I mean, I think that one of the things that you got to think about is industries. One of the things that we talk about a lot is transferable skills. You may say, well, I'm a tech guy or I'm a consumer goods person. But what can I do to take those transferable skills to other industries that may be hiring and that those other industries that may have higher pay bands, right? So thinking about, okay, well, if I have legal skills and I'm a lawyer, or if I'm a marketer, or if I'm a communications person, those skills are highly transferable. I can take those to any industry. Let me look at the industries that are hiring, and across the bow of those industries, which ones have the highest pay bands. And that means you've got to do a lot more research in terms of looking at those job openings to say, okay, what industries are hiring and what industries that are hiring are paying the highest pay bands. That's a really smart way to start to think about how you put together your strategy for that big move.
Just lastly, while we have you here, and this one is a curveball for you because I know that you're so skilled at what you do, but there's a lot more chatter, a lot of increasing thought, we should say, for employees that are afraid that their job might get taken by AI. But there's also a thought process of, how can I best equip myself to work with some of these tools and maximize my own productivity? How are you hearing that discussed? How are you hearing some who are in the workforce best position their own skill set to leverage new technology in order to be able to kind of maximize their own output?
Brad, I love this question because I think that there's a school of thought of people who are willing to sort of race with the machine and those who are thinking, I'm going to rage against it. I think that the number one thing that folks need to start doing is start to play with AI tools, ChatGPT or GitHub, or even using Copilot at work, to start to get familiar with what the tools can do and how they can best be used in your line of work. I would also say that if you do not have AI skills, or if you are not AI conversant, you need to start taking some courses around it. You can go on LinkedIn Learning. Tons of those courses are free right now. If you don't know what a large language model is, you need to get on there and start to play with those tools, and you need to start getting your skills up. We have, our research says that 71% of hiring managers are saying that they're willing to hire someone with AI skills and less experience over someone with more experience and no AI skills. That's a big deal. Don't be afraid of that. Actually lean into it and start to play with those AI tools and get those AI skills, and then talk about those AI skills on your resume and on your LinkedIn profile. Here's the deal. My prediction for this year is that the number one question that hiring managers and recruiters are going to start asking job candidates is, how are you using AI tools and AI skills in your work, your professional and your personal lives? And job candidates should be ready to answer that question and answer it with confidence, because they will likely get it. It's a big deal. I would say, too, for people from underrepresented groups, I think it's also a really important thing for all of us to get those skills, too, because AI tools and AI skills could actually be career accelerators for folks who have been, sort of underemployed in the past, or maybe have gone into jobs thinking, this is going to be my stepping stone job, and then once I get inside, I'll do this next thing. AI is going to be in high demand. There's going to be a lot of eyes on on people with AI skills, and they're going to be getting tapped for new opportunities much faster.
See, I knew you were up to the task. Andrew McCaskill, LinkedIn career expert. Andrew, great to see you as always.
Always.
Thanks. Coming up, everyone, Fed Chair Powell putting a rate cut on the table. He didn't cut yet, but maybe soon. September is what we're all eyes on right now if inflation data continues to cool. So how will a rate cut affect your wallet? We've got more on that after the break. Fed Chair Jerome Powell says a September rate cut is on the table if inflation data continues to show signs of slowing. A change in the federal funds rate will have a number of effects on Americans' wallet. One of them could be your auto payments. Here with more, let's bring in Aaron Keating, who is the Cox Automotive Executive Analyst. Great to have you here with us, Aaron, and thanks so much for taking the time. So first and foremost, how does the federal funds rate affect auto loans?
Well, of course, when the interest rates drop there, we would see a drop in auto loan rates. We don't suspect that they will actually drop them as much as perhaps like credit card rates and things like that. But every consumer out there is battling affordability right now. So if the interest rates are going to come down, it's going to impact everything else in their portfolio of what they're managing for their money. And again, as our chief economist yesterday was speaking to in reaction to Federal Chairman Powell, it was saying that, our credit card rates might decline quickly, which might free up cash. The auto rates might not free up as quickly. But the cash that the consumers might get back from having to pay a little bit less interest on those credit card expenses that have been racking up will hopefully open the wallets a little bit more for consumers to be able to purchase new and used vehicles.
And so let's talk a little bit more about that. A lot of consumers trying to figure out what's better for them. Should they buy used or should they buy new right now?
I mean, honestly, we advise every consumer to look at what is your budget? What are you looking for? We know that subcompact and compact cars and SUVs right now are selling really well. New car inventory, it's starting to stabilize. Some brands have more than others, so you are going to see some deals with different automakers. But the smaller that you go, the more affordable the car is going to be. Used vehicle listing prices are down. They're lower, 7% year over year right now. So it really just depends on what is your risk analysis of having a car that you may, in fact, have to service sooner, or going after those new car incentives that some of these dealers are trying to put onto the lot. And of course, EVs is another part of the equation that people are thinking about.
I mean, my goodness, yeah, EVs. Look, I can't get out of my mind right now, or out of my feeds, that new Volkswagen, what is it, the ID Buzz or something like that?
The ID Buzz, yeah.
It's all over my feed. So I'm trying to figure out, and many of our viewers perhaps too, in the battle and the age-old, perhaps not age-old, but at least of the last few years, trying to figure out, do I go EV or do I do standard combustion engine, ICE vehicles? Where are you seeing that net out?
So, I mean, EVs are actually holding steady, even if Tesla's losing some share. We've got some great competitors that have been coming onto the market. Again, this is a powertrain transition. It is a powertrain alternative. People do need to consider what is their comfort level with managing an EV, but we shouldn't be afraid of it. There are great incentives right now on EVs. There are good leasing deals on EVs. So for those that may be wanting to just test the waters but not feel like they're in for ownership for a long period of time, there's some great lease deals out there. I think it's a matter of comfort and desire, but they're good cars. It's a powertrain alternative. Look at both, see what you're thinking, what brand do you like best, what model size fits you best, what the look and feel of the vehicle. But I would say people shouldn't be as afraid of EVs as far as being some sort of unmanageable spaceship or something. Sure, infrastructure has to catch up. Sure, charging could be a challenge, but with the range that we get on batteries, and we're not seeing a ton of degradation on batteries when we look at our EV battery health scores through our Manheim Auto Auction business, I'm not afraid. I'm optimistic that EVs can slowly but surely make their way into a powertrain of choice for a lot of consumers.
I mean, I guess the only one that does look like a spaceship right now is really the Cybertruck. And so, that's almost more of a personal identity thing. Are you the ID Buzz or are you the Cybertruck? Pick which kind of human you are. Just lastly, while we have you here, can you provide 3 basic car buying tips right now for folks in this economy?
Sure, of course. I mean, one, work with a dealer. These guys know these cars. They know what they're selling. They know how to look across the makes, models, and help you figure out what best suits your family. So work with a dealer. It never hurts to have a salesperson with you. Don't be afraid of that process. Be flexible on your make and model when you're looking at your budget. Again, the subcompact and compact cars and SUVs are more affordably priced these days. And then consider things like insurance costs. We're all talking about how insurance costs are rising, and that is going to be repair costs rising. Again, powertrain, how much you travel, gas costs, things like this. Just make sure you're looking at the whole picture of what the cost of ownership is and your monthly figure, and make a decision from there. But let a dealer help you through that. they can really help shepherd you through the process.
Great to have you here on the show with us. Erin Keating, Cox Automotive Executive Analyst. Thanks so much for taking the time.
Thanks for having me. Take care.
Hey, coming up, everyone, 3 major e-commerce platforms reporting their earnings over the last 24 hours. What the reports can tell us about the state of the consumer. That's coming up next. Three major e-commerce companies, eBay, Etsy, and Wayfair, all reporting quarterly earnings over the last 24 hours. The mixed results offering a better look into current consumer spending habits and some potential headwinds. For more, let's bring in Igal Arunian, who is the Citi analyst here. Igal, great to have you on the show with us. So let's start perhaps with the brightest of them all. Who stood out in this batch of earnings?
Well, you just showed it on your screen there. eBay is the one of the three that's up today. They're doing a little bit better in this environment. Part of why they're doing better is because eBay does benefit from a trade down impact, where you see some of the softness in the consumer spending environment. People, rather than buying new products, they might buy refurbished ones. So they benefit a little bit from there. But some of the investments that they made into their platform are also what's driving some of the better performance there. Although I think it's fair to note that across all three, trends are certainly challenged due to the macro.
And so with that in mind, where does that put Etsy within this? Because I mean, I was just on eBay actually earlier this morning, to your point, because I was trying to trade down on something. But that means that I'm not going to perhaps some of the handmade goods or some of the merchants that are on Etsy.
Yeah, Etsy sits really in the most challenged part of the consumer spending environment right now, which is consumer non-discretionary goods, or consumer discretionary goods, rather. Sorry. So people seem to still be spending on travel. People are spending on essentials because they need to. And where you're getting the biggest cut from the wallet is on goods that you don't necessarily need. Now, Etsy certainly has a very clear consumer value proposition around those handmade products, unique products, and they're really trying to dial into that and focus there. But the part of the consumer macro that they play in has been the most challenged part, and it continues to be that way.
We got one more here as well, Wayfair. Of course, we were looking through those earnings earlier here on the day. We just had the stock reaction for our folks here, and there it is on the screen. Just like that, right on demand. All right, it's down 3.8%. I mean, this has been challenged as well, especially because you don't have as many people that are moving or need to refurbish or refurnish, I should say, a home. So Wayfair naturally gets challenged.
Yeah, speaking of soft pockets within the consumer environment, the home furnishing category has been one of the most challenged as well. On the earnings call today, the CEO talked about how the peak to trough within home furnishings is as worse as it's ever been and as bad as it's been since the great financial crisis. So that speaks to what we're seeing in the home furnishing category. You're absolutely right. People aren't moving. We saw existing home sales last week that were at 3.8 million on an annualized basis. That's pretty much at record lows. New home sales are at those types of levels as well. With people not moving, there is just less of a need to buy furniture, and with pressure on the wallet, that's certainly a category that gets pushed to the back of most people's minds. So we're still waiting for improvement in that category. Wayfair has done a lot to take out a lot of the costs and do what they can in this environment. Things haven't gotten materially worse, which is the one bright spot if you look across all three of these guys, but they really haven't gotten much better, and we've been in this holding pattern for a while.
All right, and so lastly here, we have a company that has not reported yet, and that's Amazon. We're going to be looking for that later on today here. To what extent will they give us a better reading or yet another reading on the consumer, especially with their e-commerce platform, where it won't be accounted for in this earnings report, I don't believe, because of the Prime days and when that ultimately rolls out. But perhaps they can give us a little bit more about their own engagements and what they're seeing on the platform with the consumer.
Yeah, Amazon is the bellwether. Amazon's 45% of e-commerce, and what they say certainly matters, and they'll have the best read into the consumer over almost anyone, especially on the e-commerce side. There's no question about that.
What is the prognosis or the evaluation that you would give of the consumer? I mean, I was looking at the conference board data as we all were earlier this week, and even though overall confidence ticked up, consumers still downgrading the present is what they had to say. If we were to give some type of kind of medical analysis to the health of the consumer, what would you say to that?
Yeah, I think go back to what I'd said before. The consumer is not strong, but it doesn't seem to have gotten materially worse either. So we're kind of hanging in there with inflation and pressure on wallets. People are spending where they have to, right? They're buying their milk and their eggs, and they're buying it at a much more expensive price than they were 3 or 4 years ago. And then people are still spending on entertainment and travel. That's kind of hung in there to a pretty good degree. And so there's pockets of relative strength and weakness. Overall, though, the consumer certainly remains under some level of pressure.
Yigal Arounian, Citi analyst. Great to have you as always, and thanks so much for taking some of the questions here on the day. I know that you're going to be continuing to track some of these e-commerce earnings as they come out over the rest of this earnings season. Certainly appreciate it. Coming up, everyone, anxiety and avoidance are driving the financial lives of many Americans. We'll tell you the best ways to manage your financial stress next. If you worry about your finances, this is a safe space. You are not alone. 80% of Americans are feeling anxious about their finances, according to a new survey from Discover Personal Loans. And the stress is leading many to avoid confronting their financial challenges. Here to weigh in, let's bring in Dan Nicholi, who is the Vice President of Discover Personal Loans here. Dan, great to see you, and thanks very much for joining on the program once again here. So just take us into some of the findings here and that 80% figure that we're talking about, because financial stress is typically one of the leading causes, if not the leading stressor for a lot of households.
Yeah, Brad, you said it. Our headline was that 80% of Americans are feeling some level of financial anxiety. I find it pretty interesting that that's virtually the same result we've seen for 3 years running. And at the top of the factors that are driving that stress, we see high inflation and high cost of everyday expenses, two things that are very closely linked. So you sort of said it all.
And so with that in mind, I mean, I'd love to focus on some tips for people and how they can start to tackle some of the contributors to that stress. And potentially, let's start here on debt, because you've got a few kind of strategies that people can employ here too.
Yeah, so I think the first thing you have to do is get yourself into the right frame of mind. We heard that 41% of Gen Zers avoid looking at their bank statements altogether. And 1/3 of all respondents in our survey said they don't believe they'll ever get out of debt. So you have to put yourself into a more optimistic frame of mind to be able to actually start the process. I think the first step within the process is to actually create a budget. So it might not be the most fun thing, but whether you have an app or just a simple pencil and paper, you have to actually list out all of those things that are contributing to your expenses. You can look at each one and try to figure out, can you eliminate the category entirely or at least reduce it?
Once you've got that budget set up, there's also knowing what type of debt you have and how you're really tackling that. What are the kind of, I don't want to say a 3-step process because it's far more complicated than that, but is there kind of a step-by-step that households can really start to do to take on some of that debt?
Yeah, so I'd say the best way to tackle debt is to use a strategy that works for you. Whatever sticks is the best one. There's many different options though. Two very common ones are the debt avalanche and the debt snowball. With the debt avalanche, you're going to be ranking your debts from highest interest rate to lowest and tackling them in that order to minimize total interest you're paying. With the debt snowball, you'll be starting with the smallest debts to get them off of the list and actually give yourself quick wins. And you work towards eliminating it all. But I think something that is overlooked is the potential to reduce the interest rate on that debt by potentially consolidating it and locking in a fixed interest rate.
With that in mind, I mean, as we're thinking about consolidation, a lot of people are trying to best figure out, okay, at what point have rates come down enough for it to make sense for me to reconsolidate? What should they be working through in their own thought process there?
So no one really knows, right? I wish we knew exactly what was going to happen with rates. What I would look for is a product where you win either way. And with a Discover Personal Loan, there's some really great features that I think set people up for success. One of those things being that there is no origination fee. So should they decide to take on a loan and consolidate their debt and later on rates drop, they're not going to be hit with a penalty of some sort or additional costs by refinancing one more time. It's not like a mortgage where every time you take out a mortgage or try to refinance, you have that upfront big expense. You can avoid those origination fees with a personal loan.
Certainly. Dan Nicholi, who is the Vice President of Discover Personal Loans. Thanks so much for taking the time here with us today. Good to see you, Dan.
Great to see you. Thanks for having me, Brad.
Certainly. Well, while inflation may be slowing, higher costs continue to wreak havoc on retirees' finances. Research from the Senior Citizen League shows that the value of seniors' benefits has declined 20% in the last 14 years. For more on what this means for you and your retirement account, let's bring in Yahoo Finance's own senior columnist, Carrie Hannon. Hey, Carrie.
Hey, Brad, good to be here. Right, so this report from the Senior Citizens League is a bit eye-popping in a sense that it really sort of captures the loss of how far seniors checks these Social Security benefits can go for them. And it is a pretty big dip down. They say that seniors would need an additional $370 on average per month in order to get on par with how it was back in 2010. Now, we all know inflation has taken a piece out of all of our pocketbooks, but for seniors who don't have more income coming in, this is pretty worth paying attention to. And so if you think about it, the one thing about Social Security that actually is marvelous, Brad, is that it does adjust every year for inflation. But what they are saying is that it just hasn't kept up with how seniors actually spend their dollars. So the COLA, which we call it the cost of living increase, is put together by looking at the inflation rate for wages, the CPIW, which tracks spending for wage earners. And they say that that isn't an accurate representation. And so what we have is they take what that CPIW is for July and August and September, and they look at it, the average of that, look at it, compare it to what it was the prior year. So, for example, this year, the COLA went up 3.2%. So that added about $50 a month per individual Social Security benefit receivers' paychecks. Now, seniors told the Senior Citizens League that, hey, that didn't even come close to how much their spending actually did and continues to increase. So this is worth paying attention to. I'm not sure what the right answer is to this. I mean, it's how it's all calculated, but it's one of the few things that actually is adjusted by inflation that seniors have coming. It's just they're saying it isn't enough.
Carrie, where are retirees feeling the biggest financial strain right now?
Yeah, what's interesting is most recently, Brad, when we looked at the inflation numbers from last month, we did see inflation had cooled a bit, right? So that was good news. But the things that seniors were spending on, like electricity and outpatient hospital care and things like shelter and even eggs, continued to go up. So that was one area. In the Senior Citizens League report, the things that they saw the biggest increases for seniors in spending during this time period, the 2010 to 2024 time period, were things like, obviously, cars, used cars, new cars, rent, housing costs, even real estate taxes. And curiously enough, and they even have bread on that list, one thing that sort of caught my attention is they said iPhones. And I'm not quite sure how that all plays in, but I guess it's getting to the point of staying communication and having that technology, which is really super important for seniors to have that access to communication for people.
iPhones. I didn't see that one coming either, Carrie. Maybe they're trying to get into that new generative AI features that our own Dan Halley was previewing for us. I don't know. We'll look into that one a little bit more. Carrie, thanks so much for taking the time.
Thanks, Brad.
Good to see you. Guys, coming up, gold medals, really shiny, but are they actually gold? Inez Ferre gives us the answer next on Wealth. For those keeping tabs at home or those not, we're keeping tabs for you. The U.S. has collected 31 medals total so far in the 2024 Olympics in Paris, with 6 of them being gold. Superstars like swimmer Katie Ledecky, Simone Biles, and the U.S. women's gymnastic team, and the men's 4x100-meter swimming relay team. They've stood up on the podium and accepted that first prize medal around their necks, but how much gold is really in them? Some asking the question, namely our producer. And with rising gold prices, how much are they worth? Here with some of our answers, we've got our very own Inez Ferre. Inez, I mean, of course they're priceless, right, Inez, once you've won?
That's right, but you always do wonder when they hold up that medal, hey, how much is that worth, or is that really gold, Brad? The gold medal is a highly coveted prize, of course. An Olympic gold medalist and part of the 1992 Dream Team U.S. men's basketball player Clyde Drexel is currently auctioning off his medal, with the current bidding at $270,000. But the actual medal is not worth nearly as much as that. The gold medal, first of all, is actually mostly silver, about 95% or over 500 grams. And the outer coating is the other 5% is actually gold, but just 6 grams, with gold trading at around $2,500 an ounce and silver at around $29 an ounce. That means that a gold medal is really worth about $1,086. Now, a silver medal is mostly pure silver with an iron center, with about 500 grams of silver and 18 grams of iron inside. So they're worth about $520. And then you've got the bronze medals that are about 95% copper and a little zinc at about 455 grams total. And with copper near highs, bronze medals are worth about $250. Of course, each medal, like I said, is special, and the medals this year have a piece of the Eiffel Tower in them, which adds a little extra value for all those Paris fans out there, Brad.
All right, I'm one of them. Inez, if these medals aren't worth much more than bragging rights, do athletes get paid for winning them?
Yeah, they do, and it really varies by country. So here in the U.S., gold medalists get a bonus of about $37,000. Silver medalists get around $22,000, and bronze around $15,000. But that's according to the National Olympic Committee. However, the U.S. is nowhere near where it's best paid. Here are the top 5 according to Olympic committees and local reports. Hong Kong, gold medalists get over $760,000. In Singapore, they get $745,000. Indonesia, they get $300,000. Israel, $271,000. And the Republic of Kazakhstan, gold medalists there get $250,000, Brad.
Wow, excellent breakdown. You've got our own Josh Schaefer actively watching from the newsroom, commenting live during Slack and in Slack on this, saying it's great, Inez. So I'm just relaying that message to you, and it was very good. Sounds like it's time to establish some citizenship elsewhere and become an Olympic athlete.
And win a medal too.
And win a medal. That's the key. Inez, thanks so much.
Thanks.
Well, turning now to cybersecurity. France has reported 68 cyber attacks linked to the Olympic Games since July 22nd. A big event like this has been hit before. The 2018 Winter Olympics in South Korea were hit by a cyber attack later found to be committed by Russian hackers. And the International Monetary Fund, known in your hood as the IMF, they found that cyber attacks have doubled since the pandemic. So we want to talk to a security expert about how you can protect your information and finances from these threats. Here with more, we've got Jitu Patel, who is the Cisco Executive Vice President and General Manager of Security and Collaboration. Jitu, great to speak with you here. So, as we're thinking through the best protection that people can make sure that they're putting in place for themselves, given the history of cybersecurity threats around events like this, what are some of the first steps that they should be taking?
Brad, firstly, thank you for having me. It's good to see you again. And if you think about what's happening in the world right now, the adversaries are getting more and more sophisticated, and these sporting events and venues with high density of people tend to be perfect, kind of venues for bad actors to go out and make sure that they can, that they can continue to have, threats get exercised. So what we think needs to happen is both on the on the individual side, make sure that you're actually very careful when you go out there because we are all connected. So first thing, make sure that the password that you use for any of the applications that you might have, that you keep unique passwords. Ensure that you've got two-factor authentication turned on if you don't already, because that's actually one of the largest areas where people get hacked when they don't have two-factor authentication turned on. Your Apple Pay, if you do have a phone, make sure that that's actually turned off. If you're going to someplace, don't scan QR codes that are from suspect kind of flyers, because that might take you to a malicious website. Those are the kind of precautions that you should be taking as a consumer as you go into these events, and just know that you're going to be targeted there. So just be careful and on an alert.
Why are cyber attacks becoming so prevalent at big sporting events? I mean, I remember I was able to go on a tour and actually sit within a war room and a cybersecurity war room at one of those major sporting events last year. And I was shocked at how many different threats they have to thwart on a real-time basis.
Large sporting events have always, in the history of time, been very attractive targets for attacks because of just the sheer size and scale of the impact and the disruption that can cause, right? So as a result, I think you can assume that if you have a large sporting event, that's always going to be targeted. And, for example, at the Super Bowl this year, where we have a partnership with them, Cisco's secure malware analytics blocked about 1.2 million malicious files from entering the NFL's network. So you should just expect that this is a par for the course, and it's going to get more and more intense because these attackers are not getting any less sophisticated. They're getting more sophisticated. They've got better tools. They're getting more coordinated. And so the defenses have to actually be, one step ahead at all points in time. And they do have an inherent advantage because they have to be right once, whereas a defender has to be right every single time.
G2, we only got about 15 seconds left here. I also want to kind of pivot and get some tips for travelers out there that are trying to also make sure that even as Labor Day is coming up and perhaps they have some late summer travels, that they're best protecting their information. What should they be making sure that they're checking the boxes of in their own cybersecurity?
The most important thing that you can do if you don't have two-factor authentication, make sure that you actually sign up for two-factor authentication, because that's where you see a fair amount of attacks happen. And then keep an eye on when someone sends you something. Before clicking on a website, know if that URL is in fact seems legitimate or not. Keep an eye on any kind of spelling mistakes in official emails that are coming out, because those are all the kinds of things that are telltale signs of an attack coming your way, and you want to make sure that you're careful, because an identity theft is a very traumatic experience for an individual consumer.
Certainly. G2 Patel, who is the Cisco Executive Vice President and General Manager of Security and Collaboration. Great to see you once again, G2. Hope to check back in the future.
Thank you, Brad.
Certainly.
Would love to.
That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern Time. Big earnings coming up. You don't want to miss them.